behalf of SIRC, I welcome you to this useful session on Accounting Standard Workshop. I welcome the dignitaries to the dais. The speaker of the day, first speaker of the day, Mr. Eujiction. Let's stand for the invocation song. I see an invocation song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Before getting into the session, we have the regional conference on 22nd and 23rd. I invite Sangeeta Jagannathan to give more information on this regional conference. Thank you.
Yeah, good morning, dear members. On behalf of the Institute, we are proud that our yearly flagship program of the 57th Regional Conference of SIRC is being to be held on 22nd and 23rd August at the Jawaharlal Nehru Indoor Stadium on Friday and Saturday. The conference registration fees is going on with an early bird offer, which is 5,000 rupees per member. And if you are able to register as a group of members, you have another 4,500 only, which you can register. So the idea of the goodies and the other important technical takeaways that you can have in this during this conference are: number one, around up till 1,500, we are planning to provide you with a kit and other goodies. Number one. Number two, for the technical features, you are going to have a very informative sessions covering from income tax bill by Padamchand Kincha and Chaitanya from the Bangalore group. And then you're going to have a topic by Mr. Advocate Sujit Ghosh, and a session by Advocate Arvind Dattar. And we are also going to have the Chief Minister for the inaugural session, followed by the people of the day who are part of the Tamil Nadu government, and also an economist, Dr. Palnivel Thiagarajan, will also be handling a session. And other than this, there will be topics on capital market, ESG, and the Indian Big Four also. So we are expecting these important technical coverage during the conference. Then other than this, the extra add-on activities that we have planned during this conference is the SIRC Premier League, or a sports activity with the aligning with the year's theme of work-life balance. Where we had the pickleball activity today at Chennai, and we are also planning for the cricket by next week because of rains that was not happening today. So this activity is happening across the branches, and we want people to be represented, each branch with a team, and we are planning to have the sports activity say on 21st August before the conference. Other than that, there are short exploration trips in and around Chennai which we are planning, which the members can pay and make have a group and have a trip soon after the days of the conference days during the evenings. These are the plans. So we welcome you all to register and make use of this platform of technical knowledge gaining and networking. Thank you.
Let me introduce the first speaker of the day. Mr. Eujiction is a director in the audit and assurance practice of Deloitte with over 10 years of experience providing technical expertise in audit and technical accounting services. By profession, he is also a chartered accountant and a company secretary. He has experience in multiple sectors including software, healthcare, automotive, shipping. He has handled the audit of large and mid-sized companies. With this introduction, I welcome Mr. Eujiction. I introduce Mr. Bharat to present a memento to our delegate.
Yeah, so while, am I audible? Yeah, so while the PPT is getting put up, if, as everyone would be wondering about my name, so I'll just give an introduction once again. So I am Eujiction, you can all call me UG, and I've predominantly been in the audit practice, and so starting with the session. So this session would probably be covering on Ind AS 2, which is on share-based payments, and I'm very delighted and excited to speak amongst you all, and then looking forward for a very interactive conversation on this topic. So moving on, so this is how this is how broadly we've structured the session. So it will be first we'll cover what is the objective and scope, what are what is covered under standard, what is not covered under the standard, and why there is a standard on share-based payments. And then we will probably move on to the measurement and probably give get an understanding of the definitions in the standard, and then slowly move on to the measurement piece, which is on equity settled and cash settled options, and then cover the transaction with group companies. So this is how the overall structure of the session is going to be. And and then moving on, the first is on objective and scope. So before we directly head on to objective and scope, so what according to you are covered as, probably what we'll do is, so bear with me if there is going to be a lot of basics which is going to be discussed here, but then we will try and quickly progress to certain aspects. At least we'll cover 2 or 3 aspects which are quite complex. And yes, so I'll just come down so that it is easier for me to try and interact with you all. So yeah, so what is our understanding of share-based payments? Everyone will, what and all are covered, and why do we really require a standard for share-based payments? Yeah, so ESOPs are covered, right? So generally, if a person is going to get a salary, so there will be a particular amount which will be defined in his pay return. Correct. So if I have to account for it, I will account that as the expense. But then when it comes to a share-based payment, there will not be an amount which is defined. So there is a judgment which is involved in determination of the amount. So then comes the importance of the standard. So now, so there are not only on the value, but there are multiple aspects surrounding it, right? So what is the period over which I'll recognize, and what is the date from which I'll recognize? If there are conditions, what do I do? So this is the reason why the standard is was introduced separately for share-based payments. And then, so as the objective says, so this is basically to specify the financial reporting for share-based payment transactions. The answer is there in the name of the standard itself, share-based payment transactions. So anything which is share-based payment would be covered under the standard. So now what we'll do, we will take 4 scenarios and then try and understand our perspective on what and all are covered as share-based payments and what and all are not covered as share-based payments. So let us just give a intuitive answer. I don't want an in-depth answer as per the standard. Probably everyone would have known the gist of the standard, but then give intuitive answers logically based on whatever comes to your mind immediately once you think of it. So the first topic, which will be on entity. So in a case where entity B grants 10 shares to a particular employee, and they remain, so if they remain in service for 1 year. So do you think this will get covered under the standard? How many of you think this will get covered under the standard? Yeah, so 1, 2. So the rest, do you think it is not covered under the standard? So just candid answers. So there's not going to be any, so either yes or no. So there can be only 2 answers, right? So there cannot be a maybe in this scenario. So what comes to your mind? So when there is when we spoke about the topic, right? So it is a share-based payment transaction. So what has happened in this? So there is a entity which gives shares to an employee and as a payment for his services, and they are saying after 1 year, so this will get, he will be able to exercise these shares. Correct. So, in your mind, do you think this should get covered as a share-based payment transaction? So, how many for this is a share-based payment transaction? So most of us do, right? So, so this again, as we said, so this is a shares is going to be given to the employee. So this will be will be covered under the standard. So this is the basic example of a share-based payment where this is similar to a ESOP or a share which is given to an employee, and then he stays for a particular period and then he gets the share. So now tweaking example a little bit. So now assuming today the share price is 120, right? So and so today the share price is 120, and then now if the employee stays for a particular period, so here in this case if he stays for 12 months, what the company does, it pays 120 rupees to the employee. So how many of us think that this is covered as a share-based payment transaction? Yeah, you do. Anyone else? So there are a few yeses. So how many are no? So can I assume everyone else is no? Yes. Okay. So yeah. So and why do you think is no? There's no share involved. Yeah. So now the distinction between the first question and the second question is, while you determine the value based on the share, but then when you are making a payment, it is a fixed value. So you already determined the value on day 1, right? So when you initially, so assuming I join a company today, the company tells me the today's share price will get after 3 years, right? So there's no judgment involved in this, right? So there's today's share, I'll go to the market, I'll see it's 120 rupees, and after 3 years I'm going to get 120 rupees. So this scenario, so now as most of us had said, this will not get covered under a share-based payment. So now moving on and looking at a different, further tweaking the example. So instead of me getting a share price equivalent on the date of joining, so now if the management tells me, so today you've joined, you be with the company for 3 years or be with the company for 12 months. At the end of 12 months, you will get cash value equivalent to the share price on that particular date. So now is this, immediately what comes to our mind is this is the share-based payment transaction, is this not? So it will be a share-based payment transaction. So how many are saying yes for this? So how many are saying no? Any reason for no? You're not giving shares, it's only equating the value of the share. Yeah, so here, so now the top, basically what is covered under the standard is, whenever share-based payments, this is a share-based payment, right? So whatever is, if you give an employee a share and then he stays for a particular period and then he gets the share, or if he stays in a company and then when I am finally going to make a payment, if it is derived based on the value of the share on that day, so that is what the standard tries to cover. So again going back to the definition of share-based payment transactions. So this again, so when I am staying for 3 years, so after 3 years, so the value which I am going to pay will not be the 120 rupees of share price which is going to be there now. Correct? So it will either be 140 which after 3 years, or it will either be 100 rupees. So now, so in this scenario, while it is not an actual share which is being given, but rather it is the value of cash which I'm going to give is linked to the share price of the shares. So again, this will get covered as part of the share-based payment transaction. So now moving on to the last example. So now what the company does, so it basically says, I will give you a 500 rupees of bonus if the share price of the company exceeds 10 per share during the next 12 months. Right, so I say I join a company again, so the company tells me, yeah, you will get 500 rupees if my share increases by 10%. Right, so do we think that this is a share-based payment or no? How many for yes? Yeah, so how many for no? So anyone who said yes can probably give their views on whether why this is covered, why this is not covered. Yeah, this is linked to price. So, yeah, so whoever is saying no, is there a answer to this? It is not linked to the growth in price. Yeah, so now, as you said, it is linked to the, it is linked to whether the share price increases or not, right? So when I am going to make a payment, what will be the payment which I'll make? 500 rupees, right? So does it change if there is going to be some changes in the time period or some changes in the share price? So it will be either 500 rupees or it will be 0, right? So now, does your answer change because of this, or it's still you're continuing to say that this will get covered as part of this standard? Because the standard is basically, so there are measurement uncertainties when you give a share price when you give a share to a particular person, or when you give a payment which is based on shares. So now in this scenario, so the 500 rupees amount which I'm going to pay to a particular person, right, or to an employee, so that is not going to change. So irrespective of whatever happens, so the 500 rupees is going to be the same. Probably it is linked to a share price increase in the company. So this is similar to any, so if the company says, so if the company performs well and then the profit is more than a certain threshold of crores, right? So if it's more than 50 crores, then you will get this much amount as a bonus. So how is this different from that? Is this the same scenario? So now, since the final payment which is going to be made to the employee, since that is not based on shares, but rather whether the employee gets the payment or not is based on shares. So in this scenario, so this will again not get covered as part of the standard. So yeah. So again, so share-based payment transaction. So does it change? So if I'll ask you a question. So now, if if the price is going to be, so let's say it increases by 10 rupees, right? Does it change the value which is going to get, which the employee is going to get from the company, or is it going to be the same? Correct. So as long as it is linked to shares, as long as the final payment, share-based payment, is linked to shares, the amount of payment, quantum of payment is linked to shares, it will be covered under the standard. But whether I'll give the share or not, whether I'll make a payment or not, if it is linked to the share price, so that would not get covered under the standard. Because now, if it is going to be only this 500, right? So let's say it increases by 10, so I'll record 500. So now, if it doesn't increase by 10, I will not record 500. It's 0. It's more based on a probability. Gets covered under the Ind AS 19. So which will basically be employee benefits. This is more similar to any bonus payout which you are going to make to a particular employee. So you're not making a payment which is directly linked to the share value. So any more questions on this if you're still not clear? Yeah. Yeah. So in the previous scenario, so the thing is, so when the company share price grows, so cash bonus which I'm going to give will be the shares of the company, right? So or the value of shares of the company. So on day one, if the value is 120, after 12 months, the value could be 100, the value could be 150, correct? So it is linked to the value which I'm going to pay as cash. is going to be the amount of the amount of which is equivalent to the share value on that particular day when I'm going to make a payment. Clear? Or yeah, so any other questions on this? Because the entire premise of the standard, what gets covered is basis this initial scoping which will be covered here. Yeah, so now I'll quickly progress. So now let's take an example. So why is this very complicated, right? So what makes the standard complicated, or what is the judgment involved? So generally when an employee gets paid a bonus, then I will make a payment to him, correct? So so let's say a bonus is 500 and the year is 2 years, then 500 I'll prorate it over 2 years and record it as an expense to liability, and then I'll move on in life. Now, how is it different? So let's take this example and try and understand. So without going to the standard, without going to how the standard defines, based on logic, what do we think should be the accounting for this? We'll try to understand, and then we'll try to link it back to the standard. So this is the example. So an entity grants 10 shares to his employees on April 25, and provided they remain in service for 3 years. So for you to record a expense for this transaction, what will you need? Yeah. 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 Correct. So as you said, the input is what will be the share price on that day. Correct. So now let us say the share price is on 1st of April is 200. Right. So now what will your answer be? So what will be the accounting entry in year 1, year 2, year 3? Yeah, today 200, let's say it's a listed company, the market price is 200. 200 divided by 3 years. Right. So any other answer? Everyone agrees to this? Yeah. Why 2000? 200 into 10 divided by 3. Yeah. So any other answer? Yeah. So this is the scenario. So now let's add a additional element to it. Let's say there is a exercise price. So standard basically exercise price is if I stay for 3 years, I will need to pay 50 rupees for me to get that share. Right. So now in this scenario, what do you think will be the answer for you to record a expense for share based payments? Sorry? 50 rupees as a consideration. Any other answer? Yeah, so first let me tell you, okay, so what will happen is, so many answers are coming out saying 50 rupees is the value which I'll record. So now, I'm an employee, right? I stay for 3 years. So to get these shares, what I'll do is I will pay 50 rupees to the company and I will get these shares. So from a company's perspective, what do you think is the value or cost for the company? Is it 50? How many for 50? 150. So how many for 150? Yeah, 10 shares. Let's say for one share, let us see, we'll discuss about one share. One share is 150. Everyone agrees? Yeah. Okay, so there is okay, so the question is, what if he doesn't exercise? So if it doesn't exercise, then there is no cost to the company, correct? Yeah, so let's keep this question in mind, and later when we cover the topics, we will try and address this. So current understanding, shared understanding, what everyone has is, so the value for the value which needs to be accounted for is 150, and again over 3 years, right? Everyone agrees 3 years? Yeah, so 150 will be recorded over 3 years, 50, 50, 50. And then now let's add an additional element to it. So let's say the employee stays for 3 years and then he gets the option. So it's basically a share option, it's not the share. So if I stay for 3 years, there is a exercise period window between 4 to 5 years wherein I can choose whether to purchase the share or not. For me to purchase the share, I will need to pay this 50 rupees and then I will get the shares. So in this scenario, so why do you think the employee would not exercise? Because anyway he's getting a benefit, right? Why will he not pay 50 rupees and get the shares worth of 200 rupees? Correct. So depends on the market value. So assuming the market value of the share can go below 50 rupees as well, So because so there is an uncertainty, so he might exercise whenever he thinks is favorable for him to exercise the option. So now for in this scenario, so again the same question. So what will be the expense in year 1, year 2, year 3, year 4 and year 5? Okay. Yeah, we'll assume that he'll exercise and then I will provide. So what will be the amount which I'll provide? Will present market value. Present market value, let's say, assuming let us ignore the present value factor, time value factor for a moment, but what will be the amount? So let's say we've all agreed that 150 will be the amount now, correct? So for exercise, yeah, so basically 50 rupees is the exercise price, 200 minus 50, 150 rupees. I will do I mean 150 rupees is the amount which I'll take it to expense. Will I take it to expense over 3 years? Will I take it to expense over 4 years or 5 years? 3 years. Why not 4 years? So let's say I exercise I make an assumption. So the company, I mean as a management, I have my assumption is that all the employees exercise only after the end of 5 years. Because it will be more beneficial if the company's price is increasing. So you'll need to pay only 50 rupees when they are at the end of year 5, right? So why not at the end of 5 years? Yeah, 3 years is the period in which once 3 years is completed, he'll have the option, he will be able to exercise it. He has been given the right? Yeah. Yeah, so any other answers? Anyone says 5 years? Okay, we'll move on. So now again, let's say the share has been given to 5 different employees. Okay, and then 2 of them leave. 2 of them leave in the month June 2026. Alright, so now currently we've all agreed that 150 will be the value, it will be expensed off over 3 years into into 10 shares. Right, so now how does this change anything? Okay, provision will be reversed. So let's assume for year 1, right? So year 1, none of these employees will still be in roles, right? Because this has happened only in June 2026. So for the year 25-26, they will be these employees will be on the rolls. So that what will be the value for year 1? Yeah, 150. 50, yeah, 150 divided by, no, how many employees you will, for 5 employees? 5, okay, and then, so now, understood. So now we get an answer that there could be a probability adjustment. Instead of in the first year itself, instead of recording for 5 employees, I will record for 4 employees or 3 employees basis previous trend. Everyone agrees to it, or is there a alternate answer or view we are having? What about if it occurs after the balance sheet? So this actually occurs after the balance sheet date, right? So, yeah, so the question is for everyone. So what will happen? Okay, this will be dependent on the materiality as well. Okay, we'll answer that question. Let's park the question for a moment because we will cover this and then when we go into the standards, we will answer the question. What happens? So one scenario was June 2026 after the balance sheet. Anyway, it's after the balance sheet date, but before the audit report signing date, this happens. Right. So obviously, so we will cover that question at a later point in time. So now currently there is another question is how do we account when there is going to be so generally the standard calls this as 4 features. So how does 4 features needs to be accounted for the standard? This is another question we have. So now let's say the company includes another condition. So out of the 10 shares which is granted to a particular employee, right, 20% of the shares, which is 2 shares, 2 shares will be granted. There is another condition which says only if the revenue of the company increases by 10% by December 2027, they will get these shares. There are 2 conditions. One is anyway a service condition, which is that 3 years. So the other condition is for these 2 shares. Additionally, the company should also perform well, and the revenue should be increased by 10% by December 2027. So what do you think happens because of this? So any change? Okay. So provide for 8 shares. So what about 2 shares? When will I provide for 2 shares? But it is not wrong, because if I know before 3 years, as someone said, a trend, based on previous trend, every year the company's percentage is increasing by 30%, right? So should I not record it at year 1 itself? Why will it not be? Then even the employee exercising the share is not certain, right? So why will I record a share-based expense? So yeah, so now if this is met, so how do you differentiate between the two? So one condition is there is a 3-year period which I need to stay. So that again, the employee can decide whether to stay or not, right? So now there is another condition which basically says the company's revenue share goes beyond 10%, and basis previous trend, I know that it is always 30%. So now should I also look at this condition and then record for it, or will I not do it? We will not do it. Okay. We'll analyze it and then we'll adjust it. Okay, we'll park this again, and we will again come back to the example and explain how this happens. So let's say now the last fact pattern is year 1, let's say 2026, right? So the share price remains at 200. 2027 it becomes 250. 2028 it becomes 200, 300, right? So now each year, does this change your answer, or how much needs to be taken to P&L each year? Because now historically what we've been doing is we've taken share prices 200 and then deducted 50, and then that we've taken to expense. So now let's say we are in year 3, right? 2027. The share price is 250. So now what will you do? Will you take 250 as the number for you to record the expense for the period? I'll need to restate previous years. Okay, any other answer? Any reason why? Okay, so he's saying it has to be at 200 and not at a different price. So anyone else who says it has to be at 250? Because that is the value I'm going to give, so 250 I'll consider. Yeah. No, I will not pay 200. I'm only giving him shares, right? So when I'm giving him shares, the shares will be worth 250. Then why not? So don't you think this is wrong? So I mean, as you had said, it is while keeping this. So we'll discuss only based on logic, right? So don't you think the standard is wrong by saying grant date fair value of 200 is the value which I need to consider? We'll have to restate. Yeah, so restate, you are saying it's restatement because that is you are saying it makes logical sense because that is the value of the company. So again, he gave an answer that it should be the value which is the same at year 1. Alright, so anyone else who says the value should not change from year 1? It's a contractual obligation. Understood. Yeah. No, so while the price is, so there is no, the excise price will be fixed. Yeah, so since I've already recognized, I'll not change the value. So okay, understood, got it. 200 rupees is agreed. Yeah. So generally how, I mean, just to give you a background, generally how this happens is whenever a person is given an ESOP, so the ESOP will not mention how much is the value. So this is only an accounting adjustment. When we do an accounting, we ask them to get a valuation either through binomial or through Black-Scholes, and once they get a valuation, they will assign a value to it. That value will be 200. That will not be linked in the main plan. That will not be given anywhere. So that will be a separate valuation for accounting purpose which we do. So that has 200. So now your argument is once I fixed it at 200, I will not make a change at later point in time. So your answer is it needs to be changed, right? Basis the market value. keep revaluing it. Yeah.
Based on the number of employees, even what we are doing is we are putting the interest rate assumptions, everything we will change it. Because it
Yeah.
has to be restated.
Understood. Yeah. So now, yeah.
If the company says I will give $3,000 worth of shares and the quantity is determined on the day it is giving the offer, the quantity will not change. But if the valuation changes,
Yeah, so your point is again similar to his point. If the value is going to change, you will change the value. And there are two gentlemen who have said that the value will not change because at year one you entered into a contract and you arrived at a value, you will not change it. So yeah, so now the last fact pattern will be on what happens if instead of shares, I will give cash equivalent to the number of shares. Does it change anything? It does not. Okay, so probably we'll move on. So we'll quickly cover what the standard says. So keep these questions in mind. We will again try to address them as in when we try to see what the standard talks about, right? So now moving on to the scope. So the standard broadly divides the type of shares into two different type of settlement. This basically classifies based on settlement. It is two different type of settlement, and then the third one is basically when the employee has an option to select between the two. So this is in the previous example, the last question which we had, right? So the whether the settlement happens in cash or not. So there are two scenarios. One is I stay for 3 years and I get 10 shares. The second scenario is I stay for 3 years, I get value equivalent on that day. What is the share value equivalent? I will get cash towards that extent. So the standard basically says there are two different types of accounting for these two types of settlements, and then there's a third scenario where there is an option to give it. So why the standard? Why does this differentiation need to be made? Yeah, everything is covered. So whatever we spoke in the first slide, right? So we had 4 different scenarios, and then whatever was ticked off. So both these are covered in the standard. Whether it is cash settled, but the cash settlement has to be based on a share value on the date on settlement, right? So basically these are the two scenarios which the standard talks about. And so now why is there a distinction? Okay, one there is a cash outflow, no, the other one there is not a cash outflow. So basically the premise of the standard is, so whenever you give a employee equity shares, you become a equity shareholder, and all the other case it's a liability, right? So across all the Ind AS standards, whenever they talk about equity holder, the accounting with respect to equity will always be the subsequent measurement. Whatever goes to equity will directly hit your equity. But then when it talks about a liability, so a subsequent measurement will go to P&L. So here again, when I'm going to give if I'm going to give shares to my employees, so that basically if it is called equity settled option. So the standard looks at it akin to a share transaction, transaction where the employee is a equity holder, and in the second scenario they look at it similar to a liability holder, similar to any vendor. Yeah. So now moving on. So how does it make a difference? How is the accounting? We'll probably look at it once. There are two key differences in accounting, so that we will probably cover as we go on. So these are the topics. So these are basically the definitions. We'll quickly cover each one of them, and then before we go on. So share option is basically, so it gives you an option, right? So in the scenario, it gives me an option. After 3 years, if I've stayed for 3 years, I can get the share by exercising it. So that is the share option. And then fair value and intrinsic value. So so the difference between so we will come to fair value later, while this is more of a definition which says it could be exchanged for between two parties at arm's length. But then how is it different from intrinsic value? There is a minute difference which we will cover later. And now first talk about intrinsic value. Intrinsic value is the value. So anyone in a previous example, what was the intrinsic value? difference between exercise price and the share price, right? So we saw that 200 was the share price on day one, and then we had a 50 rupees as the exercise price. So 150 which we computed. So that would be the intrinsic value. And then measurement date is is the date at which I do a fair valuation of the option. So that is basically in our case in the first of every month or at every reporting date.
Intrinsic value, 150 rupees.
Yeah.
That amount only the shares allocation.
Yeah, so basically intrinsic value is the value which the employee unlocks at a later point in time. So if I am the employee, so I exercise the options and I get the shares, I need to make a payment. So the shares is worth 1000 rupees, I need to pay 200 rupees. So for me the value is 800, correct? So that will be the intrinsic value. So in our case it is 150.
That liability share capital,
Yeah.
only 150 rupees. 150.
So that we will come to it. We in our initial when we spoke about it, we said it is 150, but there is a minute difference. It might not be 150. It's a little higher or lower. So next is on vesting conditions. So in the previous scenario, what do you think are the vesting conditions? In the example which we saw.
Employee stays for some number of years.
Yeah, 3 years. Employee staying in the company for 3 years is a vesting condition, right? So and any other vesting condition? Yeah, I'll have to. Correct. So company has to perform at a certain threshold. It has to increase its revenue by 10%. Then you will get entitled to the shares. So that is another vesting condition. So vesting conditions can either be performance-based vesting conditions or service conditions. As you said, service condition is the 3 years time period where the employee needs to stay, and then the performance condition is the company performing well and earning a revenue more than 10%. And then we have vesting period. So what is the vesting period? Why not 5 years? Anyone else? Yeah. Okay. So basically, whatever period, basically the service period which is mentioned, right? So that is the vesting period, because after 4 years, if he leaves the company also, he holds on to his ESOP, right? So then that is the vesting period. So there can be certain scenarios where, I mean, in case of what we saw was a very straightforward, plain vanilla kind of a ESOP arrangement, but then the companies in general tend to make it as complex as possible. So there can be scenarios where, while initially they will mention that 3 years is the vesting period explicitly in the grant, but then they'll say if you leave between 3 to 4 years and IPO has not happened, then you will need to forfeit your shares. So if that is the scenario, then that one period again becomes an implicit service condition. So there are additional considerations to it, but the basic principle is if you hold on to your share once the period is over, so that is your vesting period. So now moving on to measurement. So measurement. So first, first critical point what we need to understand is what date I measure. Right, so that gives the basically, so what will be the grant date of the option? So in our scenario, what is the grant date? Yeah. So gate I gave an ESOP, correct? So but why is this complex? Why does it will be very straightforward, right? So why do we need to? Why are there multiple definitions for it? Yeah. Correct. Understood. Yeah. So why is it important? What could be the ambiguity on this? So basically, what happens is so there will be multiple dates. So there will be a date on which the employee announces a plan. They form up a plan. There will be a date on which there is a board meeting date which happens, and then they approve the plan. And then at a later point in time, let's say they communicate to the employee in December, certain employees in January, right? So what will be the date? So that's why the confusion happens, because there are multiple dates in practice, and what will be the date on which I need to start recognizing expense for the employee benefit, for the shares which I've given. So this basically the standard defines an agreement is the date on which a shared understanding is entered between the employee and the company. A shared understanding is basically you do some kind of communication between the employee and the company. So for instance, I send a grant letter, I send the award letter to the employee. So that will be a shared understanding. I will send an email saying you are granted for so many number of shares, and then there should be rights which are conferred. Basically, it should say if you stay for 3 years and then you will get these shares. And the important point is on the approval. So you cannot directly give so this has to be approved by the board, right, or the respective authority in your company. So if you give a grant letter to an employee, but then it gets approved only in the after 3 months. So in the initial 3 months, while he has a letter, it's not enforceable. So if all these three factors are satisfied, so then basically it will become a grant date. In our scenario, it's April 1st because it's very straightforward. So that is the day it was given to the employee. Yeah, so we will come to it. I mean, it is part of the next slide. So yeah, so we will then is a measurement period. So what is the measurement date or the measurement period? So this again for a equity settled grant, it is the same. It is going to be the grant date, the date on which I initially give a grant to an employee. So now the difference when we spoke about what will be the share price, whether I'll keep measuring it every year or whether I'll measure it in the year one, what do I do? So as per going directly based on the standard, as he had mentioned, so with respect to equity settled options, so the standard says on day one, that is on the grant date, you will do a measurement, you will do a fair valuation of the option, and then you will not revisit it. The reason being, because they are equity shareholders, the standard looks at them as equity shareholders. So once you've given them equity, later point in time, whatever changes, you will not make any adjustment to the share option value. So in our scenario, for the 200 initially, which we determined as a share price, that will still hold good whatever be the time period. So this is for equity settled equity settled option, and no provision as such. So you will still record it based on 200, not based on 250. So the reason is extra provision is not required for the 50 rupees. So this is for equity settled option, but and the reason is because the standard looks at them as equity holders of the company. And this is not the case for cash settled. Probably once we move on to cash settled, we'll try and see what are the different aspects which we'll need to keep in mind. And so this is what I mentioned. No subsequent measurement is performed after the initial measurement date or grant date, unless, so if there is a modification of the plan, right? So later you change the plan, you cancel the plan, you say a portion has to be settled over cash. So those scenarios, there could be a modification to your share price, but unless that happens, if it is a normal share based payment and the share price keeps changing, you will not make any changes to your fair value of the option which you have determined. So moving on, so what is the time period over which you will recognize? So this again we spoke, right? So it is over the period of 3 years, which is the over period on which services are being rendered. So there could be certain scenarios where a company says you already performed for 5 years in the company, you immediately the shares are vested, then I will take the entire amount to P&L on day one itself. So it depends on the time period on which the employee is required to render services. So that is on past service and future service. So this again is the time period which we earlier saw. In our scenario, the 3 year was so grant date was 1st of April 2025, and the 3 years till 31st March 2028 will be the vesting period, and then there is a exercise period which is basically the period between the 4th and 5th year. Yeah, so it is recognized over the vesting period, as everyone had said. It will be over the 3 year period and not in the year 4 and 5. Again, the reason being, so now when the company employee has rendered service for 3 years, even if after in 4th year he leaves the company, he will still hold on to the option. So now, I will need to, so the obligation still exists. The obligation period is for 3 years, so I will need to recognize over 3 years. So now what are the conditions? Moving on to the conditions. So the standard basically divides the conditions into broadly 2 categories. One is a vesting condition, the non-vesting condition. And then within vesting condition, as we saw, it will be a performance condition or a service condition. And again, within a performance condition, there are market and non-market conditions. So first, to explain what is a non-vesting condition. Vesting condition is something where it requires if I leave the company, basically I will not forfeit the shares. But then a non-vesting condition is something where even if I leave the company, I will hold on to the shares. Right? So when I had given a previous example, so let's say 3 years is the time period which I will need to serve with the company. And then additionally, there is another condition which basically says the company needs to go for IPO over the 4th year, then you will get the shares. But then you need not be there with the company. You can quit the company, but then if the company goes for IPO, you will get the shares. So now in this scenario, this is not dependent. So you will already get the option, but then so for you to get the option, get the right, this is not relevant. So this is basically a non-vesting condition. And then vesting conditions are again split into two. One is a service condition and a performance condition. Service condition is very straightforward. Service condition is the 3-year time period, which is the vesting period in the option which we saw. And then the next performance condition will be either market condition or a non-market condition. So performance conditions is the whatever we spoke earlier, right? So on the 20% of revenue share, if the employee meets the 20% of revenue share, so that will be a performance condition. So performance condition, whether it is a market condition or non-market condition, what it determines is basically if a performance condition is directly linked to share price, it is a market condition, and if it is not linked to share price, it is a non-market condition. So how does this determine your accounting? So service condition everyone is aware, right? So it is basically 3 years. I'll expense it off over 3 years. So that determines the period over which I'll do the accounting. Yeah, so talking about service period, so let's say I grant the options to 10 employees and then 2 employees leave. So what happens? So again, so that is basically forfeiture. So the standard makes a distinction. If there is if the employee leaves before the 3-year period, right? So if the employee leaves before the 3-year period, so that is called a forfeiture. If the employee leaves between the 4th and 5th year, so that is basically, so because he is already entitled to the option, so that will not be a forfeiture. So how I'll account for forfeiture is, so either the company, if the company is going to give options for 10 employees, and then based on trend, as someone had mentioned, if they see 20% as the trend based on employees, so then they'll record only for 80% charge, and then yearly they'll do a true up. Yeah, I will do it. So 1 employee, 10 options. Year 1 I have recorded 50, year 2 I have recorded 50. 3rd year he leaves. I will reverse this 100 rupees provision to my P&L. 3rd year, yeah. So this again, there is a lot of estimation involved with respect to forfeiture. So, but if he leaves in 4th year, right? So then I will not reverse it. Even if he has not exercised it, I have not reversed it because he has stayed till the vesting period. So now again, this is in the case of 1 employee. So if there are multiple employees, right? If there are 20 employees, if there are 40 employees, if there are 100 employees. So generally in cases where it is a lower number of employees, if there is only 10 employees or 15 employees and senior top management, we don't tend to add a percentage or a forfeiture percentage to it, because the value of ESOPs will be pretty high, and then generally the trend would be such that there will not be much of attrition. So we intend to accrue the entire amount for all the 10 employees. But this happens in a case where the company gives to an option to more than 100 employees. So in that scenario, this forfeiture rate will be irrelevant, and this you need to keep revisiting it every year, and then you need to cumulatively make an adjustment. So let's say on year 1 you have 100 employees. So year 2, I estimated 20% will leave every year, right? So I would have accounted ways for 20 and 20 in 2 years. So let's say I would have accounted for 60 employees, but then in the first year only 10 employees leave. So then I'll do a cumulative adjustment for the differential value. So that's how it happens. And with respect to performance condition, so the 20% of revenue share increase which we saw earlier, right? So that what happens is, so 20% increase. So yeah, so the 20% increase. So what happens is, so if an employee basically so initial on the day 1, so this will be a performance condition. On day 1, I'll need to estimate whether this is a reasonable estimate or not. So now assuming the trend of the company is 30% each year, and then it will be met in the next 2 years, then I will record for it. I will record for the 20%. So or else if I believe that it is not a realistic estimate, I will not record for it. But then once you meet that estimate at the end of 2 years, on December 2027, at that year I will make a cumulative catch up. In certain scenarios, there could be only a performance condition, and there will not be any vesting condition. It will basically say, if the company EBITDA increases by 50%, then you will get 100 shares, right? So, and then if they mention here by 2027, so then in that scenario, 2027, 25 to 27 will become your service period as well. The vesting condition, your performance need to be met on that period, so that becomes a vesting period, because your performance only if it meets on that year, I will do a adjustment. That's why it's relevant. So here the only catch is there can be a market condition. So the standard basically says all performance conditions are fine, but then if it's a performance condition which is linked to your share price. So let's say if the share price increases by 10%, then it is called as a market condition. So here directly based on the standard, you will if there is a market condition, you will not alter your vesting period, you will only alter your share option price, which we will see shortly how to do an adjustment. So basically the takeaways are, one is vesting period. Vesting period is 3 years in our scenario, and 3 years I will record a charge over the 3-year period. And then for vesting period, if employee leaves in between, I'll account for 4 features. I will reverse the expense. If he leaves the company after the 3-year period, I will not reverse the expense. And the next is on performance condition, where it will be a market and non-market condition. Non-market condition is basically where it is linked to thresholds other than share price. Again, it is similar to a vesting condition, a service condition, where you will do an accounting. If it is a market based condition, you will do an accounting, you will adjust your fair value of option. So now going to your option value. So what was our option value in the first scenario where we saw? 150 rupees. Any other answer? $200 is the market price of the share, 50 rupees is the excise value, so 150. But we saw another definition, right? Another definition for that 150, correct? Intrinsic value. Yeah, so now 150 is the intrinsic value. Earlier, unlike in Indian GAAP, which allowed an accounting as per intrinsic value if fair value is not available. So now Ind AS does not allow accounting as per intrinsic value. So what you'll need to do is you need to determine an option value, and what will be the option value is basically you will so basically it will be adjusted. So here this is 150 rupees is the value which I'll unlock today, right? So what will happen for 3 years? So I'll estimate the 3-year value at day 1, and then I will arrive at an option value. And then these would be the input. So basically share price and exercise price will be the input, because that the base is your intrinsic value. And then these are the 4 factors which additionally affect your value. So there is the estimated volatility, which generally for listed companies based on share price volatility each year, you will get a volatility percentage. And then expected term will be your initial 3-year period plus your exercise period, which is 5 years. Generally what companies when they develop a model, instead of considering 5 years, when will they exercise? Probably if they exercise in 4 years, 4 years will be considered as a contract period. And then there is a risk-free rate, and then whether any dividend is expected. So using these models, they will finally arrive at a share option value which will be near your 150 rupees value. It will not be 150, but then it will be 170 or 180. So this generally for accounting purposes, we would require a valuation report from a chartered accountant or a registered valuer. So but we can do it on our own. Then generally in an Excel file, for at least in the Black-Scholes model is available. There are Excel file formulas. You just need to key in all these. If you have all these 6 inputs, you will need to put it inside, and then it will give you a value. But then if there are additional complexities, right? So the standard says you can choose binomial model or Black-Scholes model. Black-Scholes is a simple model, but then binomial is quite complicated. So if there are additional scenarios, if there are too many conditions, let's say there is a condition that if the market price, so if there are non-vesting conditions, or if there are market conditions, then you will need to factor it as part of your binomial model, which basically gives a number of scenarios, and then they will take an average based on that scenario analysis. No, intrinsic value is straightforward. So it is 150. So to arrive at the option value, I will need to do this method. So the rationale is, so on day one, as everyone had said, right? So day one value is 150, but then when the employee leaves after gets the option after 3 years, he will not get the value of 150. If the share price could be 200 also. So on day one, I will try and estimate what would be the value which he will unlock after 3 years. That is similar to discount. So discounting will also happen. So if you see, one of the criteria is risk-free rate. So what will happen is volatility will give you the yearly increase in share prices. Term will be give the number of years. So basis that it will give the final value, and then it will discount based on the risk-free rate, and then it will arrive at the value. Correct, yeah. Yeah, so you are saying additionally 10 shares are newly granted. Yeah, you need to do it. So grant date will be on the, so let's say I have a ESOP plan, it says 1 lakh shares will be granted. And then for employee 1, I gave it in April 26. For employee 2, I give it in March 27. So now for when you give the second employee, it will be a different grant date. You will need to do the exercise once again. But then it happens only at the grant date because it's a equity settled option. Yeah, so now No. So on year 1 itself, when we arrived at 150, instead of 150, it will be 160, 170 or some other value. Okay, so 150, 170, let's say 170 is the value. So 170 divided by 3 will be the accounting. So going back to the question. Sorry. So for private companies, valuers, what they do is they will have competitor information, and basis competitors, they will see what is the volatility of each of these. So there will be peers in your market who are listed, right? So they will take that information, or else certain values, what they do is based on the deals which they have done in the previous year. So when they have sold companies, or private equity investors, when they have actually purchased the shares, what will be the share price increase in year on year? So basis that information, they will try and benchmark this and arrive with this. No. So volatility is always, so you will take, if you are taking comparable companies, you will take 5 companies, you can average, and then that will be your volatility. But then if the company, first I have granted an option, I have made an accounting using the grant date fair value. So now in year 2, now the company goes for an IPO. I will not make any change because it's an equity settled option. So irrespective of whatever be the volatility, I will live with it. So once I have determined, it is the value. So that is for a equity settled option. Yeah, so going back to this example. Yeah, sir. So I have determined it to be 170. Year 2 it becomes 1000 rupees. I will not revisit it. I will still be 170. If there is an error, you will revisit it. If in year 1 itself you had all the information to say it is 500, then you will account it as an error. But then if actually the company has grown so much in the second year, then you will not revisit it. No need for equity settled, it will always be at the initial value. You will not change the value. Yeah, grant date fair value. Grant date option value is the value which I will need to look at. So that will not change at a later point in time. Yeah, so now going back to this example, right? So what do you think needs to be accounted in year 1? So okay, as I already pressed next. So this is not relevant because it's a equity settled option. Correct? So now what is the intrinsic value? 150, right? So and option value, let us assume is 170. It needs to go based on that models, and then need to try and estimate the number. So now for year 1, so okay, so this is basically the option. This is basically the accounting expense which I'll need to consider. Number of options multiplied by the option value, and then multiplied again by the vesting divided by the vesting period. So for year 1, what do you think will be the number of options? 10. Number of employees? 5 employees, okay. And then vesting period? 3 years. Yeah, so 10 into 5 into 170 into divided by 3 years. But then, so one adjustment, so you can either consider 5 employees or you can add a 4 feature rate. But since in this case it was only 5 employees, we've not considered a 4 feature rate. Year 2, what happens? Yeah, so 10 into 3 into 170 to 2 by 3. So now 1 by 3. So no, I didn't get you. Oh, okay, divided by 3. It's basically dividing by 3. So it is 1 year in the first year. So that is 1 divided by 3. So now second one, what happens is, so it is okay, it is 2 divided by 3 in the second one. So the only difference is it's the same. Instead of 5, it is 3, and then instead of 1 divided by 3, it is 2 divided by 3. So now we arrive at a cumulative value, and then the cumulative value is 3,400. We deduct it from the previous cumulative value, and the difference goes to expense. Okay, so now expense as salary. So it goes as a employee stock option, share-based payment expense in your salaries and below your employee benefits expense. Below your salaries and wages, it will be a separate line item. And then credit will be to equity. So the standard says equity. It will basically, you will create a ESOP reserve and then you will credit it, which will be classified in your reserves and surplus, in your other equity. Yeah. So again, so that is a cash settled option, which we will probably look at it in the. No, it will not be a liability. So this is a equity settled option. It will always be, credit will be to other equity. It needs to be reversed. So what is happening is, so here, so what is happening is we are multiplying it, you are seeing the cumulative value. Yeah, since it is cumulative, it will get factored, but then you are right, we will need to reverse the salary cost for 2 employees. So there can be scenarios where it could head to a negative number also, but then, so then it basically means that in your initial 4 feature estimation was wrong. But then there could be, because it's an estimation, a certain level of error is okay, but then it cannot be a case where you estimated only 1% or 2%, but then 40% have left, or you have estimated 40% and no one is left, right? So basically you need to do a rational estimation of that percentage. So credit will be ESOP reserve, share-based payment reserve. Generally we call it share-based payment reserve. It depends. So for certain cases, it is not. It is not a free reserve. So you can, for in cases where the Companies Act defines it as a free reserve, you will not consider. But for certain certifications, you will consider. But considering, we generally what we tend to do is we will add a note saying this is considered based on these facts. We'll put an additional note, but then the general thing is it will not get considered because it is for a specific purpose. And after that period is over, right? So after 3 years is over, once it is exercised, anyway it will get utilized and then moved to securities premium. So till that period, it is for a specific purpose, so we will not utilize it for any other purpose. It will be shown under reserves and surplus. After 3 years, if it is exercised, you will it will go to securities premium and share capital. If it is not exercised, this will get reclassified to general reserve or retained earnings for the matter. Retained earnings. Yeah. Generally 3 years. After that, 2 years will be the exercise period. After it will get lapsed, right? Yeah, there are most of the ESOPs will be like that. And if it gets lapsed, if the employee is not exercising in the 2-year period, then what will happen is that ESOP reserve will be there. It will get reclassified to some other retained earnings or general reserve. No, it will be P&L. It will be P&L to equity, and then finally I'm going to be giving him shares. So there will not be any cash payout. So when I'm giving him shares, it will be a appropriation within equity. So from ESOP reserve, it will go to this thing, securities premium. No reflection in assets. Yeah, correct. Yeah, sorry. If there is an excise price, so that will come to bank. 50 rupees will come to bank. Yeah, so performance. No, that is in December 2027. 27. So now in the third year, what happens is instead of 10, I will only do 8 because the performance is not met. So we are saying performance is not met. So I will do only for 8, and then cumulative adjustment, this will get captured. So any other questions? Yeah. So he had asked what happens if the auditors sign on July, but then in June this happen. In June the employee has left. Right. So in that scenario, generally already in this while we have not considered a forfeiture rate, but then whenever the company computes ESOP, they will consider a forfeiture rate. So whatever is the subsequent events, that is sometimes 2 employees have left in June, that would already been captured as part of the forfeiture rate. But then if it is very different from the forfeiture rate which we have considered, at times we tend to do an adjustment to that extent. But in general, this will already be considered in your computation itself. So any other questions? Yeah. Securities premium. So what will happen is if it gets exercised, I will debit cash for the exercise price which is received. I will debit ESOP reserve for the appropriation between ESOP reserve to your equity, and then I will credit. Yeah. So and then I will credit securities premium. Yeah. No. It will go to securities premium and to share capital. Share capital will be at face value, and then balance difference will go to securities premium. Yeah. So moving on. So this is the same example. What happens if the grading vesting is graded, right? So if instead of so in your, let's say I give an option. In year 1, 50 options vest. In year 2, 50, another 50 options vest. In another year 3, another 50 options vest. So what happens in that scenario? So here, basically 10,000 options are given, right? So in year 1, 10,000. So so here in this scenario, 40,000 options are given. In year 1, 10,000 options vest. Year 2, another 10,000 options vest. Year 3, another 10,000 options vest. Year 4, another 10,000 options vest. So in this scenario, how do I do an accounting? So I cannot prorate. So each different grant, I will look at it as a separate grant, and then for the respective period, I will do a pro rata accounting. So whatever is granted in year 1, I will expense it off over 1 year. Whatever is granted in granted which has a vesting period of 2 years, I will account it over 2 years, and then whatever is granted over 3 years, it will be over 3 years, and then so on. Yeah. So and then moving on. So this again is on the forfeiture rate example. So this is the same example which we covered, but then additionally they have considered a forfeiture of 80%. So this is also possible because and then once you change, so if you look at the green table below, what has happened is 50,000 options into that percentage they have considered, which is 85% is the initial estimate, and then they have changed the estimate to 88%. And then final year will be the actual. So year on year, I'll keep truing up the expectation of the actual forfeitures till I reflect the actual amount of expense which needs to go to P&L. So now going on to cash settled plan. So cash settled plan. So the only basic principle which is different is, as I said, for an equity, they are an equity shareholder. This is more similar to a liability transaction. So when it is a liability, so the difference is not only on the date of grant, but then at the each measurement date, that is at the each reporting date, I will do a fair valuation of the option, and then I will need to true it up till the time it gets settled. So what happens is, even if vesting period is 3 years, and then in year 4 he has not exercised, I will continue to do this exercise because I will need to go pay him cash, and so I will need to revisit this expense year on year. Right, so any questions on this? No. In the we will not revisit the previous year. Previous year, once it's done, it's done. In the next year, when I'm doing an accounting, at the year end, I'll do a valuation, and then I will do thing. Yeah. So so that's the reason why. So initial estimate itself is based on the future value. If you see as we had discussed on the option value, I do a based on the future value. If the future value doesn't go based on the actual assumptions which I have captured, so then that's why the difference. There should not be significant difference between them. Yeah, so the other difference is, so expense will be the debit, and instead of equity or instead of the ESOP reserve, I will credit to liability, and this liability will be restated each year basis the revised option value. Finally, that liability will be equivalent to the amount which will get settled, and then I will credit cash and then debit that liability account. So yeah, so this is again, the fair value at the end of each year till it gets settled will get revisited, and the effects of the will be done up in every reporting period year end, and then cumulative liability needs to be captured. So this is the another example. Quickly I'll run through the example in the interest of time. So year 1 $14 is the value, so year 2 $15 is the value, year 3 $18 is the fair value. So when I'm doing an accounting, so year 1 I've adjusted 500 minus 95 is the attrition into 100 SARs, so and 14.4 is the USD value which is in first year. So that I will multiply and then arrive at the expense, and then each year what I do is I will so each year the respective, if you see the difference here, so here the second year is 15.5, correct. So here from the difference from an equity settled option is that here the 15.5 is multiplied rather than 14.4, and if it is an equity settled option it will always be 14.4. And then on actual settlement, here if you look at it on the final on fifth year, it has become 25, because when he is exercising it, they would have exercised it at intrinsic value, because that is the value which we will unlock. So today if I do of option value for today's share, that should be equal to my intrinsic value, correct. So only when I am doing for a projected period after 3 years, the option value is different from an intrinsic value. So in this scenario, on the finally when it gets settled, the actual cash liability will be equivalent to the amount which he is earning from the share, so that will become equal to the intrinsic value. Yeah. So this is on mostly, I mean these are the two different types of accounting which we'll do as part of as part of share based payment options. If there are any questions, we can pick that up, or else we will we'll break for lunch. Yeah, we'll break for tea and then we will continue. Cash settle, it depends. So cash settle, it will be a liability. I will debit expense, I will credit liability, and then I will try and see when I will need to make a payment. So if you are if you are in the first year, right, so then it will be a non-current liability. But then if you are there in the fourth year where everything is already he is entitled to if he asks me, I should pay him. So then in that scenario it will be a current liability. No, it will become a first year it will be a non-current liability. Last year it will become a current liability. So cash settled is taxed. So I mean, so it depends. So it is only a withholding tax which I'll pay this thing. So it depends. So what happens is expense will be always for the gross number. So when I'm making a payment, if I'm going to make 100 rupees to the person, I'll only make 70 rupees because I'll deduct tax and then pay him. So it will, at that time I will do adjustment. Yeah. Actually need not be. A lot of private companies do the equity settle kind of accounting. So because it always depends on how the plan is structured. If the plan is saying finally you will get equity shares, right? So you will still need to account it as equity settled options. And a number of companies generally, if you do a equity settled option accounting, so mostly the grant date fair value will not change. It will be the same number. So the P&L might not fluctuate a lot. And most of the companies, when they declare an ESOP option, they link it to the equity shares rather than giving it as cash. So even for private companies as well, so if it is linked to the equity shares, then we'll need to do an accounting similar to the first scenario. Yeah, it will be to the profit. So every year, that's what. So during the vesting period, I will keep recording a expense with a corresponding hit to my equity or to my liability, depending on the case. So if a holding company issues a ESOP option to a subsidiary company, it depends on what are the, so basically if the subsidiary company gets the share of the holding company, so if the subsidiary company employees gets the share of the holding company's shares, so basically there will be two types of account. One is at the subsidiary level, So basically that's the entity where the actual service is rendered. So the expense entry comes as part of the subsidiary, but then the credit will go to, so the entry will be similar. So you will debit expense and then credit will go to equity, but it is not your ESOP reserve. So what will be, it will be like a equity contribution. And then in the holding company, there will be a contra entry. So holding company, what happens is, since there's a contribution, there's an investment account which will get debited, and then the ESOP reserve will get created at the holding company level.
Can we take the last question?
Yeah.
Last question.
Sorry. So that depends on the company, so and tax consideration. So generally tax, there is a litigative opposition. So it could be depending on cross, if there is no cross charge, there could not be a deduction. But then you can do a cross charge. But if it is going to be a cross charge, instead of in the subsidiary company, instead of crediting equity, it will be a liability. So again, the cash settled and equity settled option, right? So it is more like a cash settled. So it will credit liability, and then in the holding company you will debit, instead of investment you will debit receivable. Yeah. So yeah. Generally in the initial itself it will be agreed. So generally it will not be accounted, and then it will not even be accounted in as part of equity. Yeah. So we'll break for tea, and then.
So thank you, Eujiction, for the wonderful session. We'll move on to the next topic on operating segments. I invite Yashwanth Kumar to the dais. Please be seated. I request CA Mahesh Kumar to hand over a moment to our speaker. Please be seated. A brief introduction about our speaker. CA Yashwanth Kumar is a senior manager in Deferred, based in Chennai, with overall 7 years of experience. He has worked extensively in various engagements of multinational and domestic companies for technology, manufacturing, healthcare, power and automobile sector. With this introduction, I hand over to Yashwanth.
Thank you for giving me this opportunity. I thank ICA and SIRC for this opportunity. We will cover on this Ind AS 108 operating segments as part of this session. I'll move on to the slide. So in terms of the content, these are the agenda points which we have for the session, which includes core principle in the scope. And in terms of we'll get into detailed topics as part of this particular operating segments, and we'll cover each of them with elaborate examples as well. And we'll also look into the disclosure requirements and finally with the comparison of Ind AS versus IFRS as well as part of this standard. So let us get into the core principle as to what does this operating segment means and why it is required. So for any users of the financial informations, it is very important that they need to know what is the company is into, what type of products or services they cater, and as well as what are all the geographical areas and segments the company performs. So it is very important for the users to also understand these aspects, because accordingly they can do the evaluation on the financial statements, because these will have an impact on the financials, both in the numbers as well as the business perspective. And it also is very much required for them to understand and assess on the economic environments in which the company operates as well. So this standard, as you know, predominantly is more from a perspective of a presentation and disclosure of the financials rather than an accounting perspective. But it is very relevant for the users in par with an accounting related aspect as well. So one important item which the standards also gives up leverage to the company is that if the company also presents consolidated financial statements along with the standalone, then the companies have the option to present the operating segments and the segment reporting only as part of the consolidated financial statements. So the company in standalone, it is not required with the standard, but if the company wants to do it, they can voluntarily disclose as well. And for certain companies where this particular standard Ind AS is not applicable, in case if they wanted to present this segment information or the segment details, they can voluntarily do so. They can either have the full segment reporting application to be done, or they can also do a selective reporting as well, but they are prohibited from using the word segment reporting or segment informations in their financials, because it is something which they do it as a voluntary activity. So I will just quickly get into the key aspects of this standard. So if I have to bifurcate the standard into 5 different subtopics, so that would include first identification of the CODM, which is a chief operating decision maker. Second, on the identification of the operating segments. Third, in terms of on the aggregation of these operating segments in terms of the disclosure. Fourth, in terms of identifying how the company determines an operating segment. And last comes on the disclosure piece of it. So we will cover each one with the relevant examples so that it is easy for the audience to understand as well. Yeah.
Operating segments means you are talking about operating, non-operating, like that, or business divisions.
So this is more from a perspective of we will also have the product-wise or service-wise bifurcation of what the business the company operates, as well as on a geographical perspective as well. And it is more like how the management, how the top management looks into the business, how they perceive the business in terms of to read the financial statements. So first subtopic goes on identification of the CODM, because this is the primary factor in for us to first understand on this segment, because the entire operating segments disclosure will be decided based on how the CODM looks into the information and accordingly runs the business. Now, who is a CODM? So CODM can be either a person or can be a body or a committee as well. So there is no hard and fast rule that CODM needs to be only an individual. So CODM. Now, this is the highest level of management who is responsible for the resource allocation and the performance assessment of the company. So typically, if you see practically, the companies will have CEOs, CFOs, CXOs who will take an ultimate decision in terms of what the company has to perform and also assess the business performance of the company. So in certain cases, it may not be a one single individual who takes a decision or do all the performance assessment. It can also be a case where there's a committee which the company can set up who will take a collective decision in terms of doing these activities. So in this, predominantly, if you see in the companies, there can be a committee, there can be several committees to take a various set of decisions, or the CXOs or the CEOs also can take independent decisions as the case may be. And audit committee, I will put it differently. I will bifurcate here. Audit committee is more from a perspective of looking into the governance. They take care whether all the activities which is intended to happen, is it happening the right way with all the set of approvals. So here I will put it more towards a management perspective, where how the management looks into it. So predominantly the management has played a role in the business. Yeah.
No, CODM, whether audit committee can be a CODM.
Will not be the case, because here it is more like the management how they perceive the business, how they run the business. Whereas audit committee is more from a governance role, where they look into whether the things are happening the right way it has to be done. Board, it depends upon again how the structure is placed in that company. If it is a small private limited company and all the decisions are only taken by the board, and there is no one single individual or a committee you can take, then we can also look into how the board looks into it.
Who appoints this CODM?
So there it is not a designation nor a title. It is like as I was mentioning, if the CXO or the CEOs will be the designation, they have the right conferred on them to take any business decision. So in certain cases, as I said, a committee will be a CODM. It is more from a perspective of identifying who can take a decision or who evaluates the business. So you need not have a specific person to be titled as a CODM. It is more from a perspective on the responsibilities which is assigned. Yeah, so maybe we'll quickly get into a few examples to understand better on this CODM. So in this current scenario, so Entity D is a publicly traded manufacturer of aerospace, medical and other related equipments. Here Entity D as a CFO who takes care of for each of the aerospace, medical and consumer products. Now, Entity D, in addition to CFO for each of these divisions, also has a committee who takes care of all the decisions, which includes all the CFOs as well as the CEO of the company. Now, the management committee makes all the key operating decisions, determines allocation of resources and assess the performance of the company. Now, no one individual either on the management committee or elsewhere in the entity has the ability to override the decisions which is taken by the management committee. Now, keeping this as an example, now who would be identified to be as a CODM? Managing committee. Any other views? Yeah. So, in this case, as I was mentioning, the management committee will be the CODM, because not any individual, either the CEO or the CFOs will have the right to take any independent decisions.
Management committee different from board.
Yes, this managing committee is different from the board. Quickly getting into the next example, in terms of NTTC is a public trading company. I have given the same set of facts. Here, it has a chief operating officer for each of the segments for aerospace, medical and consumables, consumable products. Now, the chief operating officers are responsible for all the budget reporting process as such, and have a senior management personnel within the units who reports to them. Now, the chief operating officers report to this chief executive officer, who kind of takes all the resource allocation and the performance evaluation as well. Now, the chief executive officer evaluates the performance of each unit based on variety of different management reports and responsible for the entity wise allocation. Now, here you see there are three set of people involved. One, in terms of the senior managerial personnel who reports to the respective chief operating officer, and again they in turn report to chief executive officer, who kinds of takes the decisions on the business performance as well as the resource allocation. Now, in this scenario, whom do you think would be the CODM? CEO, because the principle lies the same, because he is the one who has all the rights conferred with him to take all the decisions. And now what do we call the chief operating officers? Because even they have a right to take decisions on an operating budgeting note, right? So correct. So technically we can call them as the segment managers. So basically they lead their segments, but in turn all the decisions are being taken by the CEO.
Sir,
Yeah.
in case is it left to some imagination that you should be COD, or it is defined by somebody or what?
Okay.
In this case we are assuming
Right.
that in real life scenario, what is that?
See, real life scenario also, see, we know as part of the company's DOA matrix or segregation of duties, as well as the powers which is conferred by the board. So based on that, we will be able to assess as to who will be the CODM. In fact, this should be a question we should also put as an auditor to our clients to understand better how they kind of internally monitor the activities, who has the ultimate power to take any decision. Because as such, the company will never have a designation called CODM as part of their matrix. So this is something which the management has to evaluate, and we will have to review as part of our reviews as well.
You will give in writing, sir. He is COD, company will give in writing.
So there you can look into these particular aspects. There will be no written document to tell who is a CODM, but there are two documents which you can see. One, you can understand in terms of the board approvals and the minutes as to who has the right authority to take decisions. Second, as part of the company's standard operating procedures, process documents, etc., they would have already been identified who takes a decision, because end of the day all these jargons or all these positions has to be identified by the management first. So they will identify looking into all the rights and responsibilities given, and thereby we can look into whether they have rightly assessed that particular things as well or not. Okay. So I think we discussed on the response. Moving on. Now let us get into the next subtopic of yeah, sorry.
There is no, taking the previous example,
Right.
There is no committee form, but CFO is also has responsibility to allocate. So in this case, CODM can be either CEO or CFO, or it can.
So there again judgment plays a role, and to understand who has the ultimate authority. Does CFO has the right to take independent decision apart from CEO? Because what happens is typically for any corporate or any private limited company's perspective, they will have a clear bifurcation of who has the power to do what. Now we'll have to look into in terms of who evaluates the business performance, because CFO need not necessarily look into the what to say, all the decisions what they need to take or the intricacies of doing the business. His focus will be more from a perspective of looking into the returns or evaluation how the financial performance has happened. So in that case, we need to be very clear in terms of who takes care of the activities. Yeah. Okay, so point is, so it's more talks about, as he said, it's more talks about the decisions and the business activities being assessed.
So what is the link between these operating segments and the CODMs?
Okay, so which I will be covering. Point is, to identify operating segments, only the CODM, what for him as an identified to be an operating segments, how he reviews is the place where you will identify what is an operating segment, because it is not going to be a very hard and fast rule. Okay, if the company is having 5 different set of business, need not be that all 5 different set of business needs to be an operating segment. How CODM looks and reviews all those activities, because he might look into 3 business as one single business for him to evaluate or review performance, and 2 as one. So in this case, it can be like only 2 operating segments can be there. Now, how the CODM looks into how he evaluates plays a key role in identifying what is a operating segment, because the operating segment can be different to different person. But end of the day, on a financial statements, it is important what CODM perceives it.
So you will sign it, operating statement.
So it is anyways as a part of the financial statements. So generally all the CEOs and CFOs sign that. And see, point is predominantly there is no hard and fast rule. Only the CODM will be a signatory to the financial statements, may or may not be. It is not written anywhere. But typically, knowing the board of directors sign the financial statements and CEOs and CFOs sign, predominantly in a general parlance, they are the ones who are be the CODMs.
The board minutes we can infer who is
Right.
the key management person is COD.
Correct. So we will next get into the second topic of how you identify a operating segment. So I think I will just take everyone through on this. See, there are set of things which the company has to keep in mind at the time of identifying what is an operating segment. First thing, the component. In this case, the component can be a business, component can be a geography, component can be any activity. Being able to generate a revenue and incur expenses for him to manage the business activities. Is there is a revenue being generated? Is there an activity of incurring expenses? Is it expected to generate revenue? All these things is very important. It's the first criteria for us to identify whether it is even an operating segment. If the answer to it is yes, then whether those operating results are being reviewed by the CODM to make his decisions. Now, all business activities or all the expense or revenue may or may not be reviewed by CODM, because there can be a set of activities or a particular business which is very minute or it's very small compared to the company's size. If that is not something which is not keenly reviewed by CODM, then it need not necessarily be identified to be as an operating segment. Once it is identified to be reviewed by CODM, then the next information is we need to look into whether discrete financial information is it available for the company or the management to disclose such information. If information is available for the company to put the segment reporting, then thereby it is by identified to be as an operating segment. So all these 3 are cumulative conditions where CODM reviews the information, it's a right set of business activity with all the revenues being generated and expense, and a discrete information is available, then that particular activity can be identified to be as an operating segment. Now, I will capture few cases as part of the examples. Now, the first example is on entity A and entity B, both are manufacturer tractors used for construction of the real estate. Now, entity A is structured that decisions are made and performance evaluated on a regional basis, basically the geography. Whereas entity B, they kind of evaluate the business based on the product line. Now, what would be the operating segments for entity B and entity A in this case?
For entity A, it will be based on geography. For entity B, it will be based on product mix.
Right.
But for reporting, it will be won't make any sense to anybody, right? He makes passenger vehicles, he makes trucks. He's put everything under vehicles as segment reporting. You can't get any information about it.
Agreed. So this is the place where the CODM makes a difference. If Tata Motors, if the example CEO is the CODM, if his way of reviewing the business performance in terms of looking into all the aspects,
They don't want to give extra information. That is the ultimate intention. It is not based on this. They don't want to give extra information on how much they are selling where, what is the mix of the, what is the
Type of
product
products
mix
and
of
mix.
the vehicle.
so at least the standard gives an option for them to present the way how they view it. Now,
Just
there can be,
one question.
yeah.
Suppose I'm because new age company, I work for a new age company. We do the engineering design, and then based on the engineering design, I get an export order for the product. Now, can I put the operating segment based on geography here and say both engineering services and products are the same?
Okay, so again going back to the standard, see if the CODM of the company reviews in such a scenario, because his more criteria is looking into whether he's able to make a sales in a particular geography, that's more priority for him rather than what is being sold, then the standard allows you to put that segment based on the geography.
So in this case,
Yeah,
it's manufacture of tractors and sale of tractors, both.
correct.
In operational income is sale of tractors. Other treasury income will be there, other income.
Correct.
That treasury income that will cover in the VDAs, that is treasury income and revenue from operations.
Okay, so basically if you're asking any interest income or any of,
That will come in the Ind AS 108. My doubt is.
okay. See, once we identify the operating segments, there's a list of particulars which the standard requires the companies to present, which includes, for as you said, any other non-operating relevant income. If it's going to be material, they have given a list of activities which the company has to put. So to answer your question, one of the items which the company, which standard expects the financial statements to carry is any interest income.
Non-operating.
Non-operating also, if it is going to be material.
So that will also come in this section.
Yes, it will. So that is more, I will not call it as an, it's a part of a particular segment if you are able to identify it. So if it's not be identifiable against a particular operating segment, then you can put it as part of others or an unallocated income as part of the presentation in the financial statements. So this is the second one. Entity E is a vertically integrated oil entity that sells refined products to external customers. So the refinery operation sells refined products internally to its marketing and distribution segment of entity. Basically, it's an within the same company they do an inter-division sale, and that is refinery operations will not have any external customer because all is sold to the marketing segment. The financial results of the refinery operations are prepared separately and are reviewed on a regular basis by the CODM to assess the performance. Now here, what do you think would be an operating segment?
Only one operating segment.
Okay.
From the outsider and the reader's perspective, we have to look at. Not from the internal. This is the internal arrangement where self-consumption is also happening.
Okay. So maybe I'll put my question more simplified. So here the activity is there to see whether the internal sales which is made within the company also will be identified to be an operating segment, or because or with the company at a company level they make only sale to an outsider, not within the company. Now even a sale made between the segments or between the divisions will be identified as an operating segment. That maybe that's the question.
I think it depends on the business. Suppose the internal consumption leads to altogether a different product, or it has a separate marketability and which will be reviewed by the separate CODM, then it has to be segregated to this.
Okay. Any other views?
What will be the operating segment?
Sorry, sir.
What will be the operating segments for this?
So one which you are able to clearly identify is on the refined products. That's the product which they are selling, right? So in this case, see, again sticking to what the standard tells. The standard clearly tells what the CODM looks into or reviews for it to evaluate the business. So their standard never tells that it has to be sold only to outsiders or only within the company, etc. So if the CODM looks into the business as to how that manufacturing happens and what is the sales made to inter-division is something which they have reviewed. Even a sale which is made between division of a company can be identified to be as an operating segment, because that is what the CODM is more inclined to see towards and review the business performance.
Separate review. Data they
Publish
will-
So any information of an operating segment presented in the financial statements should ultimately be reconciled to the financial statement numbers, the total turnover.
separately.
Yes. So in this case, with the facts which is available, now the entire division, end of the day, whatever the sale which happens is made between the production as well to the marketing. Now marketing is expected to sell the same product as it is. Now any information which is given for the refining operations will be the same as the company, unless otherwise there is an additional activity being performed by the marketing division.
Even the disclosure also will be the same, like separate of internal consumption also it is happening.
Right.
How it is going to be, I think you'll be covering it.
Yeah, see, I will also make that. The point here is, in this limited example, now what happens is the sales made to an external customer is handed over to the marketing division. But what happens here is the CODM is more inclined to even see what is the production being processed and sold internally to them, so that his more focus is more from a perspective of how much production is happening, what is the particulars or the performance which is happening at that particular perspective. So here, when, as I said, the operating segment will be made for the inter-division sale also, and thereby at the financial statements presentation, that particular amount has to get reconciled with the total revenue made to the external customers or presented in the financial statements. Because as I said, there can be an like-to-like sale. There will be no further valuation made by marketing team, or so that the numbers will directly tally. If not, if there is any additional services or additional activities being performed, then that will be identified to be an other segment or a separate segment. Now, moving on to another example, Entity F, a diversified pharmaceutical company, has allocated 11% of the combined assets of all the operating segments to form an operating unit to perform a research of a new drug to fight a specific disease. Now, although expenses have incurred, operating unit has yet to earn revenues. Basically, it's still in, if I have to put it as an R&D mode. They are only currently incurring expenses. There is no business which has come out of it. Discrete financial information is available for this particular financial unit, operating unit, and information is reviewed by CODM to make his business decisions. Now, with this background, do you think separate operating segment needs to be disclosed for this R&D unit?
No, so information is incomplete. Revenue is-
Okay, so revenue, it is not like revenue is not identifiable, revenue is not there, so revenue is 0. And the facts also tells that discrete financial information is available. See, point here is when you have noticed as part of the earlier slide, I would have told that particular business activity, they should have earned revenue and also incurred expenses to make a particular business activity as such. So standard clearly also again calls out to tell, just because that particular division or a particular segment does not yield a revenue, does not make it irrelevant from being showing as an operating segment, because this being an R&D unit, and the purpose of this particular unit is to bring out a new medicine and thereby market and sell those particular products, even in a year where there is no revenue, but still costs are being spent, and those information are being available for the CODM to review, because end of the day this is going to turn out to be a business for them going forward once that particular research gets over. So standard also allows, even if the revenue is 0, but discrete information is being allowed, then this can be identified to be as an operating segment.
Results will be negative only.
Results, it will be negative. So operating results can be profit or a loss.
It will show a loss.
It in this division might show a loss because there is no revenue.
That's why you see a very form. But what way would a person reading the financial statements understand this or comprehend this?
Okay, see, as part of the business activities itself, the company would have defined what is this particular division for. They would have clearly identified this is a R&D division which the company is trying to get a new drug out of it. So thereby that gives an information for the reader to read the
Okay,
financials.
the expenditure
Yes. Yeah.
R&D expenses will be covered in different activities.
It can be. The only point here is, see, it is not necessary all R&D expenses needs to be shown as an operating segment. In this case, the CODM reviews it for him to take any business decision and look into the performance. Now, for the CODM, if it is meant to be an important activity, that's the reason he is looking into it. And the financial statements is expected to reflect the way the business management looks into it. So that's the reason it is being carved out to be a separate operating segment.
Now, the standard is driving that how the management looks at the
Business.
So that's how in previous accounting standard and this accounting standard.
Correct. Previous accounting standard does not have a concept more inclined towards CODM, rather it is only towards giving a particular product wise breakup or a geographical breakup. Whereas Ind AS has more emphasis given to a CODM because the readers are also expected to know how the management looks into the business and how they evaluate the business performance. That's the primary vision of this particular standard.
Can it change year on year?
So I will also cover a few examples on that as well. Yeah, I'm covering good amount of examples because I just want to bring out that each and every fact as part of example, so it's easy for the users to understand. So entity G has an operating unit that provides content to internet websites. Entity G derives substantially of its revenue from 3 service lines: advertisement, promotions and customer care. Financial information reviewed by the CODM includes revenue by service line, but operating expenses and assets reported on a combined basis for the entire operating unit. So basically only the revenue is available but not the cost or the assets. The financial information does not include profit or loss information for the individual service lines. Now in this scenario, can each of those advertising, promotion and customer services be identified as an operating segment?
Expenses can be proportionate towards various other segments.
Okay, so currently in this case CODM doesn't apportion. He only looks at the company level, not at a product level. So in this case, anyone who has any alternative view of telling yes, this has to be shown as an operating segment?
But actually he reviews at revenue level as well, right?
Correct. So,
Ideally, you have something reviewed by CODM at revenue level. So I think you should have individual services.
okay. So again, going back to the base definition, the standard gives a very clear indicator to tell the results of that particular business activities has to be reviewed by the CODM. And here, in addition to that, discrete information is not available for each of the divisions for them to evaluate separately, or rather, only the revenue is something which is looking into it, but not as a segment of a business. So thereby, these 3 divisions will not be identified to be as a separate operating segment due to these facts.
We cannot allocate
It is not expected to get allocated because that's not the way CODM looks into it. Because if the CODM, if you would have done any bifurcation and tried to look into how the results of each division, then as you said, there can be a modus operandi as to how that expenses has to be bifurcated, which will be a set principle, then accordingly will have been bifurcated. So we'll get into the aggregation of an operating segments. So again, just to give a background of what the word aggregate means. So to give an example, like there are 5 business services or business products being performed by the company. Now, can we club any particular 2 or 3 business lines to be as one single performance operating segment? So again, standard gives a guidelines in terms of when those particular business activities or geographical, however the management looks, can be aggregated to see together. So the first condition is the aggregation is consistent with a core principle. So what's our core principle? Whether the users of the financial information will be able to take the financial and other business performance evaluation to look into it. So that if that is something which is achievable by aggregation, then those particular segments, or if you have to call it the business lines, can be aggregated. If it is yes, then you will also have to look into whether those particular segments have an similar economic characteristics. It cannot be like you cannot club a service with a product which has no correlation to each other. And third important activity is whether the nature of product similar in respect of the following activities, whether it is whether the nature of the products and service is something which is inclined towards each other, whether what is the production process, type of class of customers, methods of distribution, and regulatory environment. So if all this gives a similar response to you for you to aggregate any particular segments, then the option is available in the standard to aggregate the segments to make it as a one single operating segment. And all these factors are cumulative. So all these conditions have to be met to aggregate the operating segment. Now getting into one of the examples. So ABC Limited plans on acquiring XYZ Limited, which is in the same line of business. Now, even though XYZ Limited is a similar business, it has its own engine assembly division, which will be beneficial for ABC Limited. ABC Limited wants to know whether similar division can be aggregated if they have similar products, production process, type of customers, method of distribution. So they have provided this particular information of the business separately for ABC and business service lines for XYZ. Now, considering the principles of aggregation, what all can be aggregated, what cannot be aggregated.
First three can be aggregated.
Okay.
Last two you may not be able to aggregate.
Okay. Fuel components and engine should be separate. Okay. And others. Okay. Any other views apart from what we have got a response? So in this case, again applying the principles of aggregation, considering that there's a similar products and in the facts also tells it's a similar line of business. So the first three, considering the same process, production process same or type of products are same, it can be aggregated. Whereas fuel components and engine assembly cannot be aggregated because the product or the production process is something not same. So that has to be shown separately, and others can be clubbed together. Yes, so we have electrical, truck and auto where it can be cumulatively taken. Fuel components and engine has to be shown separately. Others can be clubbed. Yeah. So here the truck engine is the final product, as well as this engine assembly is expected to be a separate business line. It is not the same. So okay. So in this example, it is been given first the fact itself. The CODM looks into truck and auto as a separate activity. Thereby, it is first segregated. That's the background to it. Next example is on entity H is a large retailer that operates two types of stores, clothing and home products. For the purpose of Ind AS 108, entity H determines that it has two operating segments, clothing separately and home products separately. Management's report to shareholders published with the financial statement discusses the results of operation of home product stores separately in a manner different from that of the clothing stores by describing different customer demographics, products offered, sales, trends. The chairman's report also stressed important distinction between the two operating segments. Now the question is, with these facts, does the standard allow to aggregate both these segments? Any specific reason? Product is different and the end customers are different and the production process is also different. So thereby these two cannot be clubbed together. Now getting into next aspect of, now we understood what is operating segment and when we can aggregate. Now the next question is to how we have to quantify what all items can be quantified, what can be cumulatively shown. So for the company to determine what is a reportable segment, there's certain quantitative threshold prescribed by the standard. So again, these are not cumulative. Either of these, if it gets fit, the company has an option to show it as an operating segment. First one, if that particular revenue of an operating segment is greater than 10% of the total company's revenue, then it can be shown as a separate operating segment. Second option is in terms of the profit and loss. Here the numbers, irrespective of whether it's profit or loss, because certain segments can make profit, certain segments can make loss, and at a company level it can be either of one. Now here the numbers have to be looked into in absolute terms, and when comparing if that particular segment in absolute terms contributes more than 10% of the loss or the profit. So basically I will take you through in this example, because here there's a slight intricacies which we need to understand in terms of how that percentage needs to be calculated, because standard tells combined report profit of the segments which makes a profit, or the losses, cumulative losses which other segments make, whichever is higher has to be considered for the purpose of identifying the 10% threshold. And third one, if the assets of the particular operating segments crosses 10% of the combined assets of the company. So if any one of these particular criteria are met, that particular operating segment can be shown separately.
It is only maybe, it's not mandatory.
So you can, it is not mandatory. If the management still wishes to show a particular segment, even though if it doesn't meet any of these criteria, management has the option to disclose that, because it's going to be a voluntary and additional information to put it.
If it is meeting me separately.
If it has to be, if it is met, the company has to show it separately, provided CODM also reviews it, that particular segment, mandatorily. And one more criteria in addition to all these things, if after identification of all the operating segments with due consideration of all these factors, if the total operating segments identified, the total value gives a less than 75% of the revenue, then the management also has to identify other business segments to cumulatively get the total operating segments to be at least 75% of the total revenue. So basically, if I have to give an example, say operating segments identified by the management cumulatively only gives to 60% of the revenue. 40% is not being separately being reviewed with the CODM, so it goes as a cumulative number. Now in this case, the standard expects the management to further identify a 15% related revenue to be a separate segment and then be reported, so the users will be able to understand significant portion of the business of the company. We'll get into the examples for each of these as well. Now, before getting into the examples, I would wanted to take through certain key aspects which the standards also prescribes. So the first one, as we were just discussing, the operating segments, if it doesn't meet any of the quantity threshold, but the management wants to show that as a particular segment, even it is lesser contributing one, but the standard allows the management to disclose it separately, considering CODM is more interested to look into that particular activity. Second, wherever the other information about the other business and operating segments that are not reported, basically there can be some 20% of the business, 25% of the business, which the CODM doesn't look into it individually. So all those particular aspects can be looked into as a separate other segment and can be cumulatively presented in the financial statements. Third one, now coming to a particular discussion. So there can be a scenario where a particular operating segment is identified to be an operating segment only in the current year, but it was not identified to be an operating segment in the preceding year. Then the company can present that as an operating segment in the current year and also present the previous year information also to align with the current year, even though it was not presented in the previous year. So similarly, if a particular operating segment was identified in the previous year, but it is not identified in the current year. Now in that case also, if the management would want to continue to show that operating segment in the current year as well, irrespective of whether it meets the quantity or qualitative thresholds, still the management can show it and they can also present it for the current year information as well.
Current year, previous year showed current year.
Correct.
Current year.
If it is not identified to be operating segments going by the monetary thresholds, but if the management still wants to show it, they can continue to show it.
When it is not mandatory, they can do it.
If the management as such current year was not identified to be operating segment, and if they don't expect that previous year segment does not make any difference in putting the current year, they can as well ignore. So current year it may not continue to be an operating segment as well. This is more from a perspective where if the management would like to present it, because the company has been presenting that particular segment till last year, because of whatever reasons is not going to meet in the current year, but still it would want to show it to the users to have a better understanding, the standard gives that option to be done. And last piece of it is on the number of operating segments. Now the standard again does not prescribes what should be the minimum or maximum number of segments. So minimum obviously it can be at least one single segment will be there, but maximum there is no prescription. But standard also prescribes that the maximum what the company can have is 10, looking into the practicality of showing that particular information. But if the management choose to even have more than that, they can very well show it. But considering the practicality, it suggests that management can reassess if it crosses 10 operating segments to be presented. Okay. So here this is something to do with as an example in terms of identifying the which operating segment has to be presented based on the quantitative thresholds. Here if you see, the company has five different service or the product lines, and they have given the information of external revenue, internal revenue, segment assets and segments profit. Here when the company has to again look into either of one conditions. So in this particular current case, if you see, first we will get into the revenue. So the total revenue made by the company is 11,140 million. Now this 10% criteria has to be looked into for each of this particular product line or the operating segment being identified by the management. Now in this case, if you see, fuel components and others contributes to less than 10%. So prima facie from a revenue perspective, these two components need not be looked into as an operating segments, provided if it fits into any other assets or profits definition. Now again, looking into segment assets, that is also a simple calculation where the company can look into the same way. So total assets is 101 million. Now fuel component and others contribute to less than 10% of the total combined assets of the company. So again, these two components does not meet the definition to be identified as an operating segment. Now the interesting point is on the profit or loss. If you see here, out of 5 different product lines, one makes a loss, other makes a profit. Now for the purpose of identifying the percentage in terms of identifying whether it has to be done. Now the standard what it prescribes is, you will have to first add all the product lines which has making a profit. So basically 1000, 350, 340 and 50 has to be added as a separate number. It comes to 1740. Now all the product lines which has a loss has to be separately identified. Here in this case again, 100 will be a separate bucket which we need to look into. Out of these two, the higher, whichever is the higher, 100 or 1740. So in this case 1740 will be the higher value, on which is what the 10% needs to be applied for us to evaluate whether segment profit does it meet the criteria or not. So 10% of 1740 comes to 174. So in this case again, fuel components and others does not meet the criteria. So now if you have observed, electrical spare parts, truck and auto engine and engine assembly meets all or any of the criteria. So thereby a separate operating segment can be presented, whereas fuel components and others did not meet any of the criteria. Even if you have met one criteria, it should have been presented to be as an operating segment, but in this case all 3 criteria were not met, hence that need not be presented as an operating segment in the financial statements. Sorry sir?
Loss is hidden, considered. One division is making loss.
Correct.
Here. Who is reading? The fact is considered in the fact.
Okay, there are 2 points to it. One, as per standard, it is not required to be shown because it does not meet the percentage, because it is effectively less than 10%. Now, it may not necessarily influence the users of the financial information. That is the perspective in which the law was framed. But if the management wants to show that separately and they want to show it because they are going through a particular business and they want to do it, standard does not prohibits management to present it. Management can go ahead and present it as well.
And both type of revenue can be taken, external or internal or any standard specified.
So
Internal will get net off, right, in the whole company.
yeah, internal revenue can get net off. Point is, if the management, typically what will happen is total revenue is what gets presented in the financial statements, and for the purpose of deriving the quantitative factors, total revenue is what being considered, because standard talks about the total revenue at the company level and the product level. If the management would want to show that external and internal as a separate segment because of that CODM looks into it or any extra information comes out, standard does not prohibits in showing that.
Okay.
Because at the total level, it gets net off, right? So
It need not necessarily, because in this case itself, if you see, it need not necessarily gets knocked off, because internal again can be within group companies also, which can get eliminated console, but still standalone it can have a difference. Moving on to next example, identification of reportable segments. Now in this case, it's a simple example compared to the previous one. Now Significant Limited has various operating segments. They are analyzing these segments in reporting purpose as per the provisions of 108. Revenue data for operating segment A. So they have only given me the operating segment A, where segment revenue is 40, total revenue of the company is 500. Now again, segment loss is 10. The total segment loss is 90 when it comes to the total losses which the company made, all the cumulative of the losses made by the company level, and the total segment profit is 200, so cumulative of the operating profits made by the respective segments. Now in this case, does segment A becomes reportable as per the quantitative threshold? Okay, so yes, why yes? What is the thresholds you find it to be meeting?
Loss is 90.
Okay, there are maybe, if for the brevity of things, so basically that particular segment, the segments which makes losses put together is 90. There are some other segments as well. Okay, so revenue in this case is only 8%, right? 400 of 500, 40 out of 500. So it did not meet the revenue percentage calculation. Now when it comes to loss, so again, as I was explaining before, now in terms of looking into the percentage, you cannot apply 10 or as against 90. Rather, how it has to be looked into is total segments making a loss accumulates to 90, whereas the profit segments accumulates to 200. So higher of the two is 200, out of which 10%, which is 20. Now this particular segment is making a loss of only 10. So thereby it doesn't meet the requirement of presentation.
After segregation, you are saying 400 minus 20. No, 10%
10% on 200. Basically the cumulative profits for all the segments making a profit.
But loss also set off that 200 no.
No, it is not set it off. It is only the pure profits made by the segments which makes only profits. Okay. So here identification of reporting segments again. In past 3 years, entity K has grown from 100 million in sales to 1 billion in sales annually as a result of 5 different acquisitions. Entity K and each entity it acquired are managed differently. So different activities being performed and monitored separately. Due to its significant growth through acquisitions, entity K has recently reorganized its management structure and operating segments. Historical records that reflect information that is consistent with new management structure are not available. So in this case, 2 facts has to be noticed. One, during the current year, management has changed the way it reviews. Earlier it used to be 5 different activities being monitored separately. Now they have reorganized to look at it as one single segment. Second, management does not have the information for the current year for it to segregate all the 5. Now with these 2 data facts, we note that the basic criteria of identifying an operating segment, discrete information is not available for all 5, and rather CODM has also reorganized the way he reviews. It is now looked into it as one single operating segment. So thereby in this case, all the acquisitions needs to be looked into as one single particular segment for the purpose of segment reporting. And one more important thing which I also wanted to highlight is, wherever the information is something which is very difficult to determine, it is either time consuming or it takes a significant cost to invest for them to segregate the information. Standard gives an option to not to segregate and show, but mention that fact because of the time constraints or the cost effectiveness, the management has not presented. So the fact of it has to be mentioned in the financial statements.
The 10% will overrule this exemption.
10% will overrule this exemption. Point is they have to show, because point I will put it ulta. First, the management should have information first to identify whether it's an operating segment. Next comes as a threshold whether operating segment, whether I have it is more than 10% or not, because management can always identify an operating segment which is less than 10%, but there is no compulsion the management has to show it separately because it never met a 10% criteria. So in this particular case, if the management often reviews a particular information which is less than 10%, but it has no info for that to do, then effectively the qualitative has nothing to do with, because no discrete information is available.
10% criteria is met.
Right.
Compulsorily it has to be shown.
Correct.
Even if the information is not available, extra cost is required, they have to incur it.
So basically, if the information is not available, there's no discrete financial information is available at all for them to show it bifurcated. So it does, in first place itself doesn't meet the operating segment definition. So next one I was talking about, if you recall, I was talking about the 75% criteria. So here in this particular example, all the operating segments which the management has identified cumulatively only contributes to 68% of the total revenue of the company. But as per the standard, operating segments have to be identified for 75%. Now management can identify another segment which will, the cumulative of which will cross 75%. Now the question is how to identify. Is there any prescribed logic or prescribed way in which the standard helps us to identify what's for the balance 7%? So standard does not prescribe any specific activity for it. Neither it tells the highest, next highest has to be taken. No. Similarly, it does not tell how many items can be accumulated. So it is left to the management to decide which particular segment which they wanted to show it as part of, to meet the 75% criteria. So next we'll move on to the disclosure part of it. Now here standard prescribes set of disclosures and the presentation requirements in terms of how this needs to be disclosed. Now whilst I will take you through on each of the presentation requirement. So these are the broad agenda items. So basically first on the general information in terms of what the management has to show in terms of factor determining that particular reportable segment. Second, in terms of information on the profit and loss, assets, revenue, etc. Third, in terms of how that particular measurement of segment results have been presented. Fourth, in terms of reconciliation of that particular segment being presented to the full numbers of which is present in the financial statements. 5, in terms of any restatements made to previously reported information. And the last one is on the entity-wide disclosures, which includes the disclosures based on the products or services, geography, and the major customers, if what is the company is serving. Now here coming to this information on revenue, profit, and the assets. So these are the list of disclosure requirements. What are the activities or the line items to be disclosed as part of the
reportable segment can be a major customer also, is it?
It can be. I'll cover that as part of this presentation. So, so to first look into this, these are the bare minimum information which the company has to present as part of the financial statements and on the segment reporting perspective. So, as sir was also asking in terms of interest income or interest expense, etc. So, those are the key line items which the standard prescribes to put. And in addition to this, if the management want to add on to any other additional disclosures, management can do so. Again, one question is in terms of whether interest expense can be netted off with interest income. So, standard again prescribes a specific line to it to tell that if that interest revenue is one of the source of income, it's not an other income or another non-operating income, but if it's a primary source of income and management also net off the interest expense against that interest income, then they can present as a net number in the financial statements instead of gross. Predominantly any banking sector or any NBFCs, their primary revenue will be interest income. So in those cases, they have an option to net off interest expense against the interest revenue.
I mean total revenue, treasury income, not only interest, any treasury income.
Any treasury income again. Now, if you wanted to put it as part of the material items of interest income and expenses as part of Ind AS 1 itself, then you can present it. But having said that, if the management voluntarily has, if they want to do, they are free to do it.
See, assuming that
Yeah.
the company has 4 or 5 segments,
Right.
operating segments. But when it comes to the treasury, what happens, they will take the investments of the fixed deposits or whatever it may be as a common. Okay, then if it is the case, whether
Can you accumulate and show or?
Accumulated show, or then even if you take the forex hedging, okay, so that also
So in those cases, if the management is able to identify that particular to the specific operating segment or line of business, they can segregate and show it. If the management is not in a position, as you said, investments will be made based on the surplus funds the company has. You cannot attribute it to any specific line of business. In that case, you can put it as part of other unallocated income or another unallocated expenses.
Where it will be shown?
It will be shown as, so basically it will start, I will show you that presentation. So basically if you see here, this is something which the prescriptive model of showing it. So you can put it as part of all others, or one other way is showing it only the segments and then at the end showing as an unallocated item. So you can put it as part of the all other CUs. See, no, that is more to mention as a company unit, nothing else. So here they have bifurcated each of their operating segments and also have a column for others, where they can club all other small segments which they have not meet the definition of an operating segment, and also can put all their other unallocated items as well. Now certain companies, I will also show you how certain companies also looked into. So this is one way of presenting. So I will also show you another way of presenting. So if say for example, this is for assets, total assets, other assets, elimination of if there is anything, and you have a column called other unallocated amounts. So basically in our scenario, if there is an investment made in fixed deposits, investment made in mutual, you cannot attribute to any reportable segments, then you can plot it as part of the other unallocated amounts.
The income also interest earned on the fixed deposits.
Right.
Previous slides. Column A, CU you put.
That one. Sure.
Not this one.
Yeah.
Here interest earned on the total FD as he said.
Correct.
That where interest.
So in this case, there was no unallocated item. It was the management was able to identify against a specific segment. So if you see interest revenue, they have kind of plotted as part of their respective things. But if there were any particular item which the company will not be able to attribute anything, they can put it as part of all others, or they can also carve it out separately under the table to reconcile with the total number as other unallocated income. Now moving on to measurement in terms of how the amounts has to be derived in terms of presenting. So at minimum, the companies are expected to disclose these particular information. First, in terms of basis of accounting, any transactions between reportable segments. Say for example, sir was asking in terms of if there is any common expense if I want to bifurcate amongst a segment instead of showing as an other unallocated amounts basis a particular percentage of revenue or particular percentage of headcount, then the company can do so by giving a proportionate to it and also calling out how that particular expense has been proportioned to each segment. Is it based on revenue percentage or any other logical way in which the company can show it as a better presentation perspective. Nature of any differences between measurements of reportable segments profit and loss and entities profit and loss. So at a cumulative number, all the profits contributed by each segment need not necessarily tie up to the company's total profit, because there can be other non-identifiable segments or other unallocated income or expense. So management has to bridge that gap, put the reconciliation in the segment reporting to reconcile those profits of all the segments mapped to the company's total revenue or profit. Any nature of differences between reportable segment and liabilities and entities liabilities, again the same thing. So there can be a particular assets which cannot be attributable to any reportable segment, which can be carved out separately as a reconciling item. Nature of any changes for prior period in the measurement methods. So the company might change its judgment in terms of how to allocate a particular expense or how to present its operating segments. In that case, if there is any particular change, the management has to call out the reason for such changes being made in the financial statement. So one example in terms of a presentation of a stock particular item. So basically an entity which is into a grocery stores, the weighted average cost formula is what is used for the company's inventory valuation at the financial statements level. But when the CODM reviews, he reviews only based on LIFO method, not based on weighted average. Now in this case, what is the right way to present in the financial statements? Does that inventory or the COGS which the company has to put it, is it should be based on LIFO or it should be based on weighted average.
Just only on
Leaf
right? That is what he
perceives or looks into the information. Any other?
For segment he is using,
Hmm.
Humphrey uses the weighted average.
Okay, so you were mentioning weighted average is something what needs to be presented. Any other views?
Segmental information is an information we are publishing as supplemental to the main financial information. So
Correct.
main financial information representing the weighted average, it should be aligned with this segmental information, so has to be aligned with that.
Okay, so
The figures also will not match, as you said.
agreed. So here what I want to do is I want to go to the first explanation of this standard. First, it is very clearly demonstrated that the segment has to be presented in a way how the CODM looks into, because that's the bare first objective of this particular standard. So in this particular case, the valuation for the purpose of this presentation of this particular results or the assets should be based on LIFO. And to tie it out with the financial statements, management has to put a reconciliation statement to tell how that valuation based on LIFO is flowing towards how that has been done as a weighted average method. So that reconciliation has to be carved out and been called out in the financial statements.
It is against for the different segments, if they follow the different methods also.
Yes, that's how it is expected to be.
But LIFO is
This is an example. I am just giving you an how it works. See, again, LIFO is
but it's being reviewed by the
him like that. So, but at the financial statement level, management uses weighted average, is again which is approved as per the financial.
such things, even weighted average should be at the entire group price.
Correct.
Is there any reason?
See, general reason is because what happens is not all segments has to be read in the way it has to be read at a financial statements level, because it will vary. See, a particular business may not give you a right picture to put it as a weighted average. So basically, if a particular the company runs into an say for example some FMCG products. Now effectively what will happen is it runs on a FIFO basis on in terms of the way it purchases and sells. Now it may not the CODM would always wanted to know what is the actual gross margin the company has made by making the sales. Now it will be more appropriate for the CODM to review to see what's the actual cost against the relevant revenue rather than putting as a weighted average to see what is the gross margin made. So there can be instances and the justifications why the CODM can look into in terms of looking into it, because there can be, my example was from an FIFO basis. So there can be any other activity which is based on LIFO basis also. So depending upon the business requirement, how things are being reviewed, that's how the operating segments are being looked into. So it is more from a perspective where the users are expected to know how the management looks into it. I think that's just comes under the entire umbrella, because it is not expected to what I want to see, rather I wanted to know how the management looks into it.
Whether management or board, how they look at it.
Correct.
For the investors side,
So from the investor side, you have plenty other information which is available in the financial statements itself, which will gives a picture. See, the purpose is to more to look into, because what happens is there can be a diverse number of business which the management looks into. Now, unless otherwise you see at each reporting segment level and to monitor how the management looks into. End of the day, management is nothing but people who serve for the shareholders, right? So shareholders wanted to look how the business being looked at. It cannot be looked into how they wanted to. That's the primary agenda. Sorry, sir. Exactly. So that is the next requirement. In fact, so the company has to provide all these reconciliations in its financial statements, starting from revenue, profit, assets, liabilities. If they are presenting any other material information, say company can also put a separate property, plant and equipment to show that I've invested more. Now all that the summation of all the operating segment need not match to the financials. So every single number which is being presented has to get reconciled to the final financial statements numbers.
this is brought in Ind AS. They have two reconciliations.
Yes. So again, this is more just an presentation. I think we just looked into it in terms of the purpose agenda. The purpose of this entire table is to just see that reportable segments are being shown separately, others are shown separately, and then reconcile to the final financial numbers, be it revenue or assets or financial P&L information. So this is something where generally in a companies or listed companies, how they have presented in their financial statements in a very practical scenario, just a snip of it. So in terms of, you can see how they have done their external inter-segment sales and what is the revenue under each product line, because the CODM has identified these to be as their review activities. And again, if you see here from the P&L perspective, they have given the results also in each classification, and thereby reconciling finally to the P&L, which is getting reflected in the P&L statement of profit and loss. Now, coming to the next item on the entity-wide disclosures. So standard also prescribes, in addition to that particular information of whatever the operating segments are there, these information are also being provided to the financial statement users. One in terms of the products and service, second one on the geography, and third one on the based on the major customers to whom the products or services are being sold or rendered. On the products, again, it is based on the segments which the management has identified to be reviewed by the CODM from a product perspective. From the geographical perspective, it is generally it is expected to show the exact geography in which the company sells. So on the right side of the table, you see the company has disclosed US, Canada, the geography in which the company makes a revenue or its assets held. Now, if the management has also option to show as an either domicile country, which is India, and foreign countries which is outside India. If the management wants to give a further information as to each country wise or each location in a particular country or each zone of a particular like a continent, so the management is free to give that particular information as well. Now, coming to the information about the major customers. So again, the management is expected to disclose an information if any particular major sale as made to major customers who contribute more than 10% of the overall sale, then the management has to disclose the fact that to how many customers the company has made a sales more than 10% of the total combined sale. And again, the company has to also tell in which segment of that particular business this particular sale has happened. But having said that, the management need not disclose the name of the customer. It's only about disclosing, okay, to show how much the concentration of the business towards how many customers are being entitled to. So again, few other key points which the standard also prescribes. First one, I think I've covered in terms of the practical nature of how many segments can be reported, which can be limited to 10 and can be practically looked into how much can be done. Next, in terms of if the management, does the standard gives any exemptions to the companies not to disclose any segment at all or to not even show a segment reporting. Standard clearly prohibits company to take any exemption. Every company has to mandatorily show the operating segments. And third point I have again covered, in case of the management does not have to report anything under Ind AS 108, but it voluntarily wants to show, they can show either full disclosures or a selective disclosures, but they cannot use the word segment information or a segment reporting. And other things I have already covered in terms of the reconciliation. It has to get reconciled with the company's overall financial statements as such. And the last part which I also wanted to do in terms of the subsequent events. So in case the company during the year or at the end of the year reviews the particular information in a set principle or a set format, but subsequent to the year end, if they change the way in which they review, now does it impact the financial statement? It has it to be presented as how it was done during the year or based on the recent practice. The standard again gives a clear indication to tell the way in which the CODM reviews as at end of the reporting period is what needs to be presented in the financial statement. Any subsequent changes need not be given impact to the financial statements as an adjusting event. Basically, it's a non-adjusting event. And the last piece is on in terms of what is the gap adjustment between Ind AS and IFRS. So there are no predominantly there are no gap adjustments. The only difference between Ind AS and IFRS is Ind AS requires you to follow all these particular requirements if the Ind AS is applicable to the company because of any threshold requirements. But IFRS, this is applicable only for the entities which are listed or in the process of getting listed in the regulatory environments. Any questions? Again, segment reporting has to be looked into at each state standalone level. So the console all the standalone, how that being presented at each standalone level has to be presented as it is, as a consolidated statement.
Or you can choose to keep it only in the consolidated.
So standard always gives a prescription to show only in console. You have an option not to show it in standalone, but if to be precise to your question, if 4 entities show a standalone and how that needs to be shown in a console, it has to, the console has to give the same picture how it reflected in all the 4. So basically you cannot do an aggregation of again 2 different entities to be together, because CODM is going to be different for each entity, not at a consolidated level.
Say, for example, an Indian company is having a foreign subsidiary.
Right.
It's a 100% foreign subsidiary. So Dubai and as well as Singapore.
Right.
So they are also doing some very good, significant business, and their revenue is also been contributing. Right? At the consolidation level, in Singapore business they have few segments. In Dubai they have
Different segments.
In India there are having 5 to 6 segments. If it is the case, in the console, we have to see the Indian business, Dubai business, and Singapore business. Is it enough?
No, again you will have to apply the principles of operating segment. Now point is there, you will have to see how the CODM looks into. If he only looks into based on geography, then it might be sufficient to show as a geographical based segment. But again, as I said, at the entity-wide disclosure level, you will also have to show for the products. But to give a much more clarity on it, say for example, if Indian entity gives product A or geography A and B, and the subsidiary gives A and C, can both the A's can be clubbed together when it comes to console, and B and C has to be shown separately.
So, for the console, how the CODM at board level or at the company level, how they look at it, the information.
That also has to
Also
be
we have to present it in the console.
correct. Okay, any other questions?
Very excellent.
Thank you very much. Thank you.
Thank you, Yashwanth, for the wonderful session. Lunch is being served opposite. We'll regroup again at 1:50. Thank you.
ಇಲ್ಲ sir. No. Yes sir. Yeah. Yes sir, but if they see the tax rate, which the indexation, if present indexation benefit is not there, but if you see any gain which is going to come on the taxable amount, so that tax percentage used to be used for deferred tax is normally any deferred tax amount we consider temporary difference, which will be considered 30%. But if the mode of settling the land or selling the land, getting the proceeds is different than the accounting through business, that means by selling and all those things, the tax rate used is 20% tax rate. So yeah, so for deferred tax, yeah.
Sale of land or property, you're going to admit that as profit of sale of land, which is going to be disallowed while you compute income tax. And then based on that, you will be arrive at the capital gains and arrive at the provision for taxation. Then where is the difference?
I'll clarify your question, sir.
That's what I am telling, sir.
So I'll just clarify your question. I think he was trying to explain when a land is classified as an investment property. Very recently, the benefit of indexation was removed under the tax laws. He was explaining when the benefit of indexation was available. Let us say in the year 2000 you bought land and it is capitalized in your books. Let's say it is at 100. It's at about 10 crores in value. Both in books as well as in tax, the land value is only 10 crores, right? Whereas if you had classified this as an investment property, when we will classify as investment property, you are expecting to earn a capital appreciation by sale of that land. So which means you are expecting that to sell. That is when you classify it as an investment property. 1 minute, sir. When you expect it to sell, right? you bought it in the year 2000, 20 years there is a inflation index that is applicable for the under the Income Tax Act. So if the indexation benefit is at that point in time it's 300, now it is 800, your land value under the tax laws will move from 10 crores into 800 by 300, which will be 900 by 300 for example, it will be 3 times higher, right? Then the land value will become 30 crores instead of 10 crores in the Income Tax Act. Whereas in the accounting books, you will still keep it at 10 crores only. You will never change that. Automatically, there is a difference between the book base and tax base is arising here. That is what he is talking about as temporary difference here.
No, it's conversion is an intention. No, sir. See, so as yeah. So basically, sir, the confusion is the tax base. So we need to arrive at the what is the tax base for identifying the deferred tax, because I know my accounting base is as per finance statements, but I need to arrive at the tax base also for each of the account balance. Accordingly, if there is any difference in tax base and the accounting base, I will create a deferred tax. But even when I am accounting at the tax, arriving at tax base, my intention has to be looked into. Suppose my land I am keeping only for business purpose, then there is no difference between tax base and the accounting base for the land. But when my intention is to get a capital appreciation for that from that land, so then my accounting treatment changed as investment property. I will disclose an account based investment property. But for tax purpose, I need to consider the fair value indexation benefit, what is on which I need to pay the capital gains tax. That's where the differential will come, and according deferred tax rates will change and the amount also will change. That is what we are trying to explain, sir. So that again depends on the accounting treatment I decided, sir. So if I decided my account treatment is cost, then whatever initial cost is 100, it will be considered as accounting base. But my accounting policy is fair value investment property, then accordingly my investment accounting base automatically changes every year when I am done the fair value. So the difference also will change the deferred tax computation. Yes, the based on the accounting policy adopted by the company. Yeah, correct. Yes, the example is only cases where it is. No, it's good only. So that's what we are telling. So the tax base of an asset is the amount that will be deductible for tax purposes against any taxable benefits that will flow to the entity when it recounts to the amount. So I just want to give an example here. Each of this, so we need to arrive at the tax base and accounting base like this for each of the balance sheet item, and then accordingly arrive whether the temporary difference results in an deferred tax liability or asset. Then based on the deferred tax liability, I will apply the rates. So this is for tax base of assets. Accordingly, I also need to create for tax base of liabilities. So liabilities mostly that 43B which we have discussed, that deductible, future it is get deductible, so that's why the tax base is 0, and I will get an DTA. So each of these account balance sheet line items, you need to arrive at the taxable base and then accordingly identify the DTA, DTL. So some of the items, even though which is not there in the finance statements, you need to create an DTA, DTL. For example, there are preliminary expenses. So I may have charged off in the books in the in the year in which I incurred itself, but as per tax I need to take it for a period of 5 years, as a 35D. So if you go by balance sheet approach, you won't be able to see this item as an identifying for DTA, DTL, but you also need to see any expense which I am deductible for tax loss also, and accordingly create DTA and DTL on that particular items also. On a nutshell, if the carrying amount as per the finance statements is greater than the tax base, then it will be creating a taxable temporary difference for assets. For liabilities is a deductible tax temporary difference. And if carrying amount less than tax base, it will be an deductible temporary difference, and for liabilities a taxable temporary difference. If it is carrying amount and tax base is same, there is no impact on the DTR, DTL. So this is the example which we discussed, that land example. So where they have explained some of the scenarios. If they intend to sell as part of slum sale, so there won't be any difference. As you said, in slum sale there is no difference between tax base and the accounting base. Accordingly, no tax will come, temporary difference will come. And if it is an investment property and they want to sell it, the indexation benefit is there, there is a deferred tax amount will come as an deductible temporary difference. Yes. Yes, sir. So the next item is the company applies a revaluation model. So for that purpose, in the example they given, indexed value is 15 lakhs, fair value is 22 lakhs. So suppose if I did the fair value of the land, so then accordingly that fair value of the freehold land, and if I am going to sell it, the indexation cost difference will come as an deductible tax difference. So even normal land, sir, if you do the fair value in your books, then it will create a temporary difference. So the rates. Yeah. So the rates, why it is important is, as we discussed now, the rates, how I am going to settle the liability or settle the accounting base, that depends, that makes a criteria for arriving at the rates which I used to use. So if a capital gains tax, it will be 20% only I need to use, even though my tax percentage for my company is 30%. Deferred tax asset on that particular item has to be recognized only at 20%. So that is the reason we need to see taxes used are those expected to apply to the period when the asset is realized or liability is settled. It also depends on the expected manner of recovery of settlement. And tax rates used that have been enacted subsequently. So if any tax rate change is there for the financial year 24-25 subsequently, which is applicable for 24-25, we need to use that latest rates because it is enacted for the 24-25. And in some jurisdiction there is an graded tax is there. Suppose there are graded tax means if the income is 0 to 25, like a personal income tax. If it is 0 to 22 lakhs, it will be 10%, all those things. The rate which I need to use for deferred tax is the average rate of the taxable computation. So that is the rate I should use for the deferred tax computation. So this example, an item of property, plant equipment has carrying amount of 100 and tax rate of 60. So a tax rate 25% applicable if the item was sold, and tax rate 20% applicable if it is used as other income. So in this case, the company intention is to sell. The deferred tax liability is created on 14 to 20%. If it is not intended to sell, then it will be continued at 14 to 25%. That is what we discussed in the first item called expected manner of recovery of settlement. The next one is tax enactment. There is a change in tax in the future period or even in the part of the year. Suppose if my part of the year, there is an amendment came from 1st April 27, my year is Jan 2016 to December 2017. So the first 3 months I need to use 30%, and the balance 9 months I need to use the applicable rate of 25%. And this is the graded type of tax rates, where the income tax applicable according to this percentage for my in the respective jurisdiction. Then I will arrive at the applicable estimated tax rate, that is 33%, 34% each of the year. This 33% average rate I will use for deferred tax calculation for arriving in the deferred tax amount. Clear, sir? Can I move on? And any change in rates after the reporting period, no impact, only disclosure has to be given for if there is a significant impact. And this is a deferred tax asset will also. So this is we discussed between the temporary differences between accounting books and the tax base. Even deferred tax can also arise at different times also. That is when you acquired a business combination. So if you have fair valued at the time of business combination, you fair valued the assets and liabilities of the company which you are acquiring. At that time also you need to see whether deferred tax impact will arise or not arise. Accordingly, you need to consider the deferred tax liability or asset at the time of business combination. So the basic is we need to see whether temporary difference arises on the initial recognition of asset and liability. If no need to recognize deferred tax impact. And if it is equal tax and the transaction gives rise to equitable tax and accounting differences, then you need to recognize deferred tax impact. And if it is not, was liability or asset acquired in a business combination, if it is in a business combination, then accordingly, if no, then you need to recognize deferred tax impact. If no, then we need to go back to next step where the transaction gives rise to asset or liability, that either accounting profit or taxable profit at the time of transaction. So if it is impacting any of the accounting profit or taxable profit at the time of acquisition, again we need to recognize deferred tax impact. If there is no impact in all the cases, then you don't need to recognize the deferred tax asset on that acquisition. So there one more case also where if the tax there is one exception called in this case, tax based on asset liability under initial recognition differs from its carrying amount. So if there is any tax based difference which is arising at the time of initial recognition itself, in that case I should not recognize any deferred tax asset or liability because it's coming at the starting initial recognition itself. For example, in the scenario of the second example, if you see the company is taken an asset for 1000 rupees, but 1500 rupees, where the depreciation eligible for the tax purpose is only 1000. So that means 500 is not eligible for an depreciation eligibility under income tax laws. In that case, I have a temporary difference of 500 when I am recognizing the asset itself. So in that scenarios, you should not recognize the deferred tax liability or asset when the difference arises only at the time of initial recognition itself, because it's not eligible in the future periods of a tax. So there is no need for recognizing the deferred tax assets or liabilities in that case. And some of the other initial recognition exemptions. This we already discussed, if it is a carrying amount greater than tax based temporary difference and all those things. So if there is a deferred tax liability, so we need to recognize the deferred tax liability in full. But if there is a deferred tax asset, then we need to assess whether the company has able to generate sufficient taxable profits in the future years. So that is one criteria we need to assess it for deferred tax asset. But in case of deferred tax liabilities, it has to be recognized in full and at the time of raising the deferred tax liability itself. So how we need to assess this future taxable profits is we need to see. So in AS 22, it will call for virtual certainty with supporting with convincing evidence. But in Ind AS, it is slightly reduced. It's not virtual certainty. It can be reasonable certainty, but with a supporting convincing evidence. So we need to see whether from the same taxation authority they can able to adjust with the losses in the future years, or any expansion plans the company has where it can generate the future taxable profits. Accordingly, we need to see whether I can able to recover this deferred tax I am going to recognize today on the carry forward losses and the temporary difference also. So this is a case study. If I have a reasonable certainty, then I can able to recognize the deferred tax asset on the total carry forward losses. If I don't have any reasonable certainty, and then I can restrict my deferred tax asset only to the extent of deferred tax liability. So if you see in the example, sir, the temporary differences is 30,000. So the DTL on that is $9,000. The company has an carry forward loss which is around $40,000. On that, the deferred tax asset I can create eligible to create is 12,000. And the company also expect the future profits will generate. Accordingly, they created deferred tax asset of 12,000. But in the second case, they are not sure whether they are able to generate the carry for future taxable profits. In that case, if you see, the DTA has been recognized only to the extent of DTL. So they have not recognized the DTA of 12,000. They recognized only 9,000, which is equal to the DTL amount. So because the company believes that they won't be able to generate the tax future taxable profits, wherein they can adjust this deferred tax excess deferred tax asset. And there are specific certain cases are there wherein in business combination, so we'll able to get the goodwill. So normally when we see the goodwill there is no now it is not allowed as considered for taxation purposes. So there is a timing difference arise. So what the act says is you don't need to recognize the deferred tax asset or liability on the goodwill, because even if you create, again you will increase notionally the goodwill, and again it comes as deferred liability. So accordingly, the standard prohibits to recognize any goodwill on the business combination, deferred tax asset on the business combination. Suppose when we are identifying an deferred tax asset, the company has carry forward tax losses. Till now, they have not accounted any deferred tax asset on that because they don't have any future profits. But the company where they are acquiring has sufficient tax profits, so the company can assess their position of deferred tax asset and accordingly create the deferred tax asset if they are able to generate the future profits from the acquired entity. And then in case of share-based payment transactions, so the difference comes here is in books purposes, I will eligible to claim expense only on the fair value difference on the date of grant and the exercise price. But the tax says that the difference between the exercise price and the market value on the date of options exercised. That means when the shares has been given to the employees. So there is a difference in the amount arrived between the date of grant and the exercise price. So those differences can be considered as an deferred tax as not only as remuneration expense difference, it also includes some part of equity. So accordingly, the deferred tax arising over and above the share-based payment expense, which I recognize in P&L, has to be directly accounted in equity, not in the deferred P&L. Because I have not given him only for the services is provided. Since he is there for so long, I am giving him some equity portion also. Accordingly, the portion related to equity has to go to equity. It should be kept under other equity. These are the two specific scenarios wherein the special consideration has to be considered while accounting the deferred tax assets and liabilities. And subsequent changes, so whatever deferred tax asset or liability which I created has to be assessed on an every year-end basis to see whether any changes in the stance I have taken in the previous years or any change in tax rates. And if there is any change in tax laws happens or recoverability of DTA condition has been changed, accordingly I can change my deferred tax asset or liability in the period in which the change occurs. And these are the further. So then one more concept is the uncertainty or income tax treatments, wherein basically, sir, we may have seen many contingent liabilities in our balance sheets. So wherein company may have taken a stand for computing the taxable profit, and department may have disallowed that stand, saying that it should have been considered as a different aspect. So this appendix C helps in accounting how these items has to be accounted in the books of accounts. If the company believes they are able to won the case and the treatment what they have taken is correct, then no need to change anything. The existing treatment suffice. If the company believes, based on the further discussions with the assessing officer and all those things, that the stand taken by them in a particular year is incorrect, it may impact in other years also. Then they can assess under two methods: most likely method or the expected value method. That means they may have scenarios where the company is confident, saying that okay, out of 4 disallowances, I may consider as 2 disallowances is correct by the assessing officer, 2 are not correct by the assessing officer. If the company decides based on the legal position saying that yes, the what the stand I have taken is incorrect, then the most possible solution they need to identify, and the tax on that has to be accounted in the books of accounts, even though the case is going on with the department. And if the same treatment has been given in future year and the other years also, the impact on those other years also has to be accounted in the books of accounts in which the company has made the assessment. This is one change where it is covered under Appendix C to Ind AS 12. And in terms of presentation and disclosure, so if any item of deferred tax and current tax has been created through P&L, the deferred tax also has been created through P&L only. If it's again deferred tax created on through OCI, basically the gratuity items where we used to put the assumption changes as part of OCI. So the deferred tax on that items also has to be considered through OCI. And directly equity, if there are any financial instruments where I recognize directly in equity, the deferred tax impact has to be considered in equity. Yeah. Yes, sir. OCI means that only. So basically, if you have done the revaluation, sir, of PPE, so there is a gain came. The company decides I will consider this as an other comprehensive income gain. So the deferred tax also you should create on that gain through other comprehensive income. Generally, it will be like the company. Non-operation income is no, sir. There are interest income and all won't come here, sir. Yeah. It doesn't mean on non-operation income, sir. There are specific account treatment has to be decided by the company. See, basic revaluation under STOIL standard, I used to put revaluation gains or loss also in the P&L, even though I revalued my asset from 100 to 200 rupees. But the now Ind AS says is it's a notional gain you are creating. You have not sold anything and you didn't get anything. So if you want to have a better presentation, you need to show these items under other comprehensive income. So then accordingly there is a taxable difference will change here. The deferred tax also on these items has to be shown under OCI. That is the change. But not all non-operational items will come under this. Suppose interest expense, that is not OCI. The interest income on bank deposits, that is not OCI. It still come under other income only. Not all, sir. On translation, sir. Yeah. Translation of foreign operations. Not on the payable, receivable forex changes won't come under this, sir. If you are subsidiary where you are translating the USD numbers of subsidiary into INR, there is a forex gain will come. That normally we used to show under OCI. So if any deferred tax arising on that items has to come in OCI. Yes, sir. The changes in assumptions because of which there is some impact will come, that normally we recognize in OCI. So that also can be comes through OCI. No. Yes, sir. That will, if it is a gain, it will come in other income, sir. If it is expense, it will come in other expense. Yes. And in terms of disclosure, sir, so that income tax assets or liabilities has to be netted off only when you have a legally enforceable right. If they don't have legal enforceable right, it has to be shown separate. Like 1 year, one assessment year you have a receivable, another assessment year is you have a liability for income tax asset. So you can only net off and show only if the company has legal enforceable right. Otherwise, the assessment years where they have a asset has to be shown in assets, and where they have liability, they have to shown in liabilities. And in the same case applicable deferred tax liabilities also, you can net off the deferred tax asset liability only if you have and legal enforceable right. That's why if you see in consolidation finance statements where you will show the entities where they have deferred tax assets separately as deferred tax asset, the entities where they have deferred tax liability as an deferred tax liability in the non-current liabilities. So because I don't have legal enforceable right to knock off the deferred tax liability of one entity with another entity deferred tax asset. And then tax expense related to OCI has to be shown separate in OCI. If it is P&L, it has to be shown separate in P&L. If they have any last year income tax excess provision and all those things also has to be shown under current tax separately as a separate line item. And we also need to give the effective tax reconciliation as a note where based on accounting profit and the tax rate applicable to the company and how the income tax expense has been arrived. What are the differences which has been the effective tax rate coming in the P&L for tax rate, and what is the tax rate if I apply the standard rate applicable to the company on accounting profit. That note also has to be given as part of the finance statements. And if I have unrecognized any deferred tax assets, so where the company is just saying that I don't have future taxable profits, so I won't recognize any unrecognized any DTA. So that statement also, how much is that amount I have not recognized, can be stated as part of the disclosure. And if there is a tax holiday period, you can disclose to what extent to which year the tax holidays exist and what is the expiry of the tax holiday period. And in terms of the other items like interest on advance tax, if you paid, that can't be considered as an income tax expense. It has to be considered as interest cost. We need to disclose. Yeah. Finance cost. It should be considered as interest expense and disclosed under finance cost, not as part of the income tax expense. And any penalties levied also can't be considered as part of the income tax expense. It can be seen whether it is an compensatory in nature. If that is the case, it can be considered as finance cost. It is not compensatory in nature. Accordingly, we can disclose in other expenses which are under the relevant heads. And in terms of differences between Ind AS and AS, as we discussed, the Ind AS is a balance sheet approach, and other as well AS 22 is an income approach. And the recognition of DTA, here we have to know, here there is no concept of virtual certainty. That means I need to have pretty sure, but AS 22 clearly says you should have virtual certainty, but in AS that virtual certainty has been removed. It can be only reasonable certainty. And recognition of current tax and deferred tax in profit and OCI, then there is no concept of OCI in S12 AS 22. And then DTL arising out of revaluation of assets, they have given a specific recognition treatment how to consider on DTL revaluation of assets, but it's not mentioned specifically in the AS 22. and which was attempted to be discussed. And deferred tax and tax holidays does not specifically mentioned in the Ind AS 22 how to treat the profits arising on special holidays, but AS 22 has given some references how to do it as part of the standard. That's all I have, sir. There are no major changes in IFRS also. It's just the some of the benefits, tax benefits should be recognized in P&L, but we have concept of OCA or in equity that is mentioned in Ind AS 12. And Pillar 2 rules not yet notified, so there's nothing mentioned as part of the Ind AS 12 also. Any questions? Yeah. Solong, sir. Yes, sir. So basically, sir, ESOP in my P&L, I'll recognize the tax ESOP expense as the difference between the DT, the fair value on the date of grant and the exercise price, which will be considered as an expense for the ESOP for the tax account, for the accounting books. But for the tax, the expense which to consider is the exercise price and the date on which the shares has been given to the party. So there is a fair value change is there between when I accounted and when the company has given the shares to the respective person. So there is a difference will arise between the accounting expense and tax expense. That has to be accounted as a deferred tax asset or liability. But if it is more than the expense recognized, it has to be taken to directly equity, not to the P&L. Suppose my accounting difference is 1 lakh rupees, but the difference as per tax is 2 lakhs. Till 1 lakh, the deferred tax has to be created in P&L. Balance 1 lakh I should recognize directly in equity. Any questions, sir? No, sir. These are all, both terms you can use interchange, sir. There is no change. No, sir. Since it is a permanent difference, there is no impact comes in the tax and the books accounts. Yes, sir. That is permanent difference. So I can't account that in the books. So nowhere, even if I recognize, I can't do it anything. Okay. Thank you. Thanks you all for the presentation.
I request CA Swarna Prakash to present a small memento on behalf of SIRC. A brief introduction about Balachandar. Balachandar is currently in Deloitte, currently working as a director. He specializes in audit and assurance. He has handled statutory audits, group audits, tax audits across various industries. Thank you, sir.
Thank you, sir, for the brief introduction. And first of all, I'd like to thank you, the SISC of ICAI, for giving me the opportunity to present on the statement of cash flows. Yeah. Okay. And warm good afternoon to all the members present here. Okay. So just sure. Yeah. I think most of the members here be well aware of balance sheet, P&L, cash flows, right? So just to get quick insights, why we do a cash flow statement, why the management or the entity prepares cash flow statement. Is there a requirement in this? Yes. Is it mandated within this? Okay. Okay. If it's a newly incorporated company, say for example, the company is incorporated on June 2024 and they're preparing the balance sheet for the first time on March 31, 2025. Is the company required to prepare a cash flow statement?
Because the base will be zero, right?
Right. So now the member says base is zero, so the entity not required to prepare a cash flow statement. Is it right?
Even for the current year, what is cash flows from operations and those things should be shown.
Wow, I get multiple answers. One member is saying there's no requirement, other member is saying there's a requirement. The other member is saying that only subsidiary company need to prepare, not the parent company. Yes, sir.
Even on the approval,
Yes.
this is very important. What money has come into the business, what money has gone out.
Right.
This should actually this is the basic of accounting.
Wow.
Rather than going approvals.
So you're saying it's mandatory. Okay. The standard is mandated. Okay. So being a first year or a last year, the company has to prepare a cash flow statement. Yeah. So with this base, I'm just getting into the agenda. Yeah. So I'm going to touch upon the overview of a statement of cash flows. I'm going to bring you the key concepts the members can take away from the key concepts. There will be a lot of examples in this session, which will be more interactive. I would like to say it's going to be interactive with you people. And yeah, I'm going to touch upon the classification in the sense that 3 activities we normally call operating, financing, investing. Certain entities will get confused where to classify the particular item, whether it's a financing activity or not. So I'm going to touch upon the classification part, and there are other presentation disclosures as mandated by the statement of cash flows as per the standard, and the difference between the IGAP and the Ind AS, and I'll also touch upon the IAS 7, and finally on the common pitfalls. Yeah. So I think everyone aware a cash flow means there should be a cash flows. It can be a inflow or outflow, right? And cash generally has been defined as per standard is that a cash in hand and a demand deposits. Why not current account, or why not why not bank overdraft, why not banks, or maybe cash credit is not being classified as a demand deposits, or maybe cash and cash equivalents? Anyone? Okay. So cash is, as per definition, is cash in hand and demand deposits, and there is a concept called cash and cash equivalents also. Cash equivalents, as you put it here, I think it was not here. Okay, I will touch upon the next slide. There is a definition for cash and cash equivalents that it should be held for minimum 3 months. So that's a highly liquid investments. There are certain items can be classified as cash and cash equivalents. So in this case, I'm going to touch upon, there is a savings account, there is a current account, there is a bank overdraft, there is a cash credit. These are multiple types of accounts normally our clients feel keeping it, and they want to disclose it in either will be in investment or financing or maybe operating, right? So now I want to know, is the bank overdraft and the current account and savings account, these are the 3 types of accounts being held by the entity, which will form part of the cash and cash equivalents.
Term deposits.
Okay. So time deposits.
Bank overdraft is a liability.
Okay. What if the bank overdraft is a positive balance as at the year end?
It is cash equivalent because it will come on the asset side.
Okay. So if it's asset, I'm getting 2 views here. It form part of the cash and cash equivalents, right? So as you said, and you were saying the demand deposits. So okay. Okay. So the answer lies here. It depends on the entity's accounting policy and the entity's cash management policy. So that's what the standard prescribes. I'm going to touch upon in the latest slide. The entity management classified, or they want to cash manage the overdraft facility for a short term on a repayable of demand, it takes the position of a cash and cash equivalents as per the standard. Okay, so that is a slight difference. I think maybe this is a common myth across all the members here. Maybe to bring a clarity that the management, their policy says that they want to have a overdraft facility for a short term period, which is repayable on demand, will be normally classified as a cash and cash equivalents. Yeah. So now I think everyone knows the activities, operating, financing, right? Any examples on operating activities?
So operating activities, normal sale and purchase, regular operations.
Okay.
Not for the objective.
Okay. So it's going to represent the operations of the company. Fantastic. Any other examples? Wow. So working capital movements. Thank you. Any other examples? Because if you see in a cash flow statement, most of the items will fall in the operating activities rather than the investing and the financing activities. All non-cash items. So just want to hear more from you, madam. So why non-cash items want to be part of operating activities? Wow. So you were saying that it doesn't form part of, like, it is not, it is basically a non-cash flow item. So cash flow has to replicate or has to present only the cash flow items. That's why the standard requires to carve out the or take out the non-cash flow items. So that's why we will add back all the cash expenses or non-cash expenses. If it's non-cash income, we will reduce it from the cash flows. Fantastic. Okay, the reporting part. There are two types of reporting available for operating activities. I just put up here, which is direct method and indirect method. Any views on why direct method and indirect method? What was the thought process behind to bring this direct indirect method?
Many of the companies only follow indirect. I'm not seeing any balance sheet.
Yes.
Briefly, capital direct.
Okay. So before getting into that definition, I thought I'll get some views from the members so that I'll get into the concept back. So most of the companies, as rightly said, yes, in India predominantly most of the companies prefer to disclose as an indirect method rather than the direct method. Okay. So okay, any key differences between direct and indirect before getting into the topic? Let's thoughts from your end.
Direct method will start with sales, is it?
Wow.
Is it?
Direct is more about cash basis.
Super. So as you rightly said, sir, direct method more emphasis on the cash receipts and cash payments, whereas indirect method, what normally typically the companies follow is that they will start with a profit rather than other things. So they will start with the profit, add back non-cash, get into the working capital movements. That's the indirect method of presenting it. Whereas direct method allows the management to come and present the cash receipts separately, cash payments separately, adjust for the other items, adjust for non-cash, and arrive the operating activities. So that's a tip. I think I got your.
More difficult, right, to capture.
Actually, if you look, sir, if you read the standard was encouraging all the entities to prepare a direct method, because direct method is always preferable for the entities and as well auditors also to look at the future cash flows, which is not possible or not maybe not be more relevant in indirect method. It will replicate more future cash flows. How much is the cash the company is received from the customers? How much is the cash the company is making payment for its purchases or for expenses or for employees? The realistic cash flows which can be seen in the direct method, which not be in the indirect method. That's why standards, the words of encourage has been mentioned in the standard itself to say that you go for direct method, but as typical mindset of the entity is that okay, why should I go? I'll rather bring an indirect method. Right.
Payment to suppliers will come here.
Yeah. Cash payment to suppliers, cash payment to employees, cash payment to expenses. Yes, it's a separate disclosure in the direct method.
And operating activities.
Exactly. I am touching only on operating activity. I am not talking on investing activity and financial activity for direct and indirect method. The direct and indirect is only for the operating activity. Okay. And for financing, investing, the methods are same. There is no difference between direct and indirect. Okay. Second one on cash flows on financing, investing activities. We generally been disclosed on gross basis rather than on net basis. Any thought process why Ind AS specifically brings this thing? Why gross based cash flows has to be disclosed in investment and financing activities? Why not the net based financing or investing activities?
It helps the users of the financial statement to determine that what was the exact increase. It was multiple dimensions. Say, for example, investing means the investments, specific investments in mutual funds or specific investments in subsidiary companies. The user of the financial statements has to understand what kinds of investments has to be paid and what's the income out of that account. So it should be classified really on the
Okay.
If I purchase a PPND,
Sell the PPND. Okay.
that should not net it out. Right?
Okay. So one of the member is saying that the users, how they see the financial statements, how they see the cash flow statements by giving the gross will give more thought process or maybe more enlightened analysis on the gross cash flows. The other member is saying that taking the purchase of the property, plant, and equipment, in nutshell we get fixed assets. I will purchase fixed assets, I will sell fixed assets. If I do a net, I will net it off and I'll show only net balance. will not reflect a true picture of whether how much is I bought, how much I sold. So and we are very close to the topic. Okay. Yes, sir.
Briefly, difference what is investing and financing activity?
Yes.
What is the
So,
main difference?
the next slide is on that, sir. This I am going to just touch upon your thoughts on before getting into the session. I am going to touch upon what is operating. I am going to touch upon investing activity and financing activity. I am going to give you little more examples on that part, so get more clarity, so that people will be more familiar with these kind of activities. Right. So I will touch upon the gross basis and net basis in the later slide. I will try to get you more examples with answers addressing it. Okay, the final on the disclosure part. So hope everyone knows the disclosure, right? Starts with profit and ends with cash and opening cash and closing cash. Actually speaking, the standard not only asks for profit, operating activities, investing activities, and the financing activities, it also recommends or not, it mandates the company to come and disclose in the financial statement a reconciliation between the cash and cash equivalents, yes, opening and closing for both the years in the cash flow statement or somewhere in the notes. What is cash and cash equivalents being disclosed in the face of the balance sheet? What is cash and cash equivalents shown in the statement of cash flows? So reconciliation is mandated. I think I am getting into the topic part. So operating activities people already touch upon. It's a principal activity, basically a revenue generation activities where the entity normally gets the cash flows, could be possible inflows and as well as the outflows part. That's why it's called as operating activities. And generally operating activities does not classify or not form part of the investment or financing activities. Okay, coming to the investment activities, a quick example here is that if an entity, they have surplus cash, they want to invest in a fixed deposits for more of 6 months or maybe 12 months. So purely investment for a temporary purpose. So they will normally classify as an investment. So I will go and make a FD, I will redeem FD, I will make once again FD, I will redeem FD. This could be typical things.
3 months also.
If it's a 3 months, that's a good question. I'm going to answer in the next slide. And financing activities, basically financing activities is anything is going to touch on the equity or the borrowings of the company. The cash flow has to disclosed only in the financing activity, not in the investment in the operating activity. So that's about the 3 types of activities being mandated by the cash flow statement. And yeah, I think I all touch upon cash and demand deposits. So cash and cash equivalents, why there is a slight myth or maybe there are a lot of judgments involved in this to bring more particular on the standards of define certain items, what can be formed part of cash and cash equivalents. Cash everyone knows, which is cash in hand or a demand deposits. But what about the cash equivalents? It's a highly liquid investments. What is highly liquid? It does not have any risk. It will not have any risk in change of values. It can be redeemed in cash within a 3 months time. So standard is very clear. If you have a highly liquid investments which has a 3 months maturity from the date of acquisition. Please be very clear on that part. It says on the acquisition date, the maturity period is 3 months, it will form part of the cash equivalents. And I think there are a lot of examples here. And certain investments where the entity go and makes only to meet the short-term commitments. So for example, I have a payments in 90th day. The company will open the FD and exactly redeem the FD and make it on the 90th day. So these are the short-term commitments they will make for investments. So that also form part of the cash and cash equivalents. So I think I already touched upon the cash management. Moving on to this, I think, so demand deposits everyone is aware, right? So coming back to the cash credit and bank overdraft, as I said, cash credit is basically the funding arrangement with the bank, which normally the company has to go for it in case they need, and it's a financing activity. It cannot form part of the operating or investing at all. Whereas bank overdraft, most of the times it can be negative, most of the times can be positive also. If the entity's management prefers that they want to use like a short-term repayable on demand, it takes the color of cash and cash equivalents and does not form part of any of the 3 activities. In case it's going to be repayable on demand, not repayable on demand, then it takes the color of financing activity. So that's a slight variation between the bank overdraft part. I think this we already touched upon, direct indirect method. Okay, I think one of the members said non-cash flow items in the operating activities. Here are the few examples that can be here. Non-cash items not only in finance, not only in operating, or also in investment, also in financing activities. Okay, so what if, I'm just going to read about here. If the company wants to issue a shares to the some shareholder, but company is not intended to get the cash from the shareholder, they want to get an asset from the shareholder. So it's going to be a share against, they're going to get a kind or some other asset. So it doesn't go to impact the cash flow, because neither the company is going to receive any cash flow from the shareholder, nor they are going to sell anything. So in this case, it will not form part of the cash flow statement. So the standard, so there are further items like bonus shares. Obviously bonus shares is a free of things given to the shareholders, so it cannot be a form part of cash flow. And exchange of assets I cover upon, debentures conversions. So if these items are there, if it's not forming part of the cash flows, then what is mandate for the company? But the company will keep issuing bonus shares, keep converting the debentures. So how the users will know if it's not reproduced in the cash flow statement? Because cash flow is very clear, they have to disclose only the cash flow, not the non-cash flows. As you rightly said, sir, so Ind AS mandates the companies to go and disclose anywhere in the financial statements if there are certain non-cash flow transactions happen. As you rightly said, it is equity. Please try to give a note very clearly saying the company has issued bonus shares or company has converted the debentures to equity in the respective schedule or somewhere in the financial statements by way of notes. Yes, right. I think this is on the gross basis and net basis. I think examples, maybe first one I would like to emphasize. This is a insurance company. Typically the insurance company, what happens? They will receive premium from their customers. Whenever the customer comes for a claim, they will just process it for refund. In case the customer has paid excess premium, they want to refund it out. So it typically, this is normally a operating activity for insurance company. So they said that instead of going for a gross accounting, saying that I have received so much of premium and I have processed so much of claims, the standard allows the companies to go for a net accounting, net disclosure basically here. And similarly here, I am taking in fixed deposits or maybe making investment in some equity shares or mutual funds, where companies, you can see, they will make more investment mutual funds, maybe once in 3 months, once in 6 months, once in 9 months, they keep investing, they will keep redeeming it, right. So the standard allows in such a case, if any mutual funds or equities being invested beyond 3 months, but anything beyond 3 months, it cannot take a color of cash and cash equivalents. Hence, you can go and present a net account, net cash flows instead of gross cash flows, saying that this is the amount of investments made in the mutual funds. This is the amount of redemption in the mutual funds. So there is no need of two separate lines in the cash flow statement under investing activity. Instead of that, standard allows them to go for a net based disclosure. Yes.
Beyond 3 months.
Yes.
Investment, suppose interest.
Beyond 3 months, if it's a trustee management activity, it has to come in the investing activity.
Simple FD.
A simple FD, if the
Beyond 3 months, FD pays are interest. But coming finance activity or
so if any company, if they have a FDs, they put up with the bank for more than 3 months, it will form part of an investing activity. If it's an investment company, the primary purpose is, principle is only for making investment, it form part of operating activity. But typically, yeah, Other companies,
3 months also.
less than 3 months, it takes the color of cash and cash equivalents. It will come in the down as cash and opening cash and closing cash. It will not form part of any of the 3 cash flows. Okay. Okay, I think the previous session was about the taxation. Yes, add-on point from the taxation part. I think most of the people have seen cash flow statement where income tax either paid or income tax refund is been forming part of the operating cash flows. Most of the people will not be noticed that there is income tax forming part of investing activity as well as taxes on financing activities. So the standard is mandated if the tax is identified on the investment item and financing item, then the entity has to mandatorily disclose under the taxes part under the investment activity or the financing activity unless it is impracticable. So I'm having an example here. So this is a loss making company. The business is a loss. However, in investment they made a huge capital gain. So as per taxation, the capital gain can be adjusted against the business loss. So finally end up with some tax amount in the P&L. So it's impractical for the company to say, I don't have any tax in the operating. I have a huge thing in the capital gain because I am setting up against my capital gain against my business loss. So those kind of impractical situations, the standard is allowing the company to go for a presentation in the operating activity itself instead of going for an investment activity. Otherwise, if it's practically possible, the standard allows or standard mandates to go and present under the respective activity, not only in the operating activity. Okay.
Interestingly, do not come across many cash flows.
I think you people might have seen earlier there was a dividend distribution tax whenever the company makes payments. So you might have noticed in financing activity, but most of the companies in investmenting activities, I don't think so. I have witnessed something in taxation on investment side, but DTT, it was there earlier. It was been disclosed under financing activity.
Generally, the tax provision will be added back and tax paid only will be shown. So,
Okay.
and that's the concept of showing it respective.
Okay. So for example, in this case, there's a company made 100 crores profit. They not paid single amount of tax as at the year end. They make a provision for 25 crores as a tax because the 30% is coming. If that is the case, P&L will reflect PBT as 100 and tax as 25, net profit as 75. Comes to cash flow, income tax paid will be 0. Why? They doesn't pay any single amount of tax. So provisions, 1 second cash flow statement is a non-cash flow item, cannot form part of your cash flow. In case the company has paid out of 25 crores, 10 crores as a payment as advance tax, then the 10 crores of advance tax paid will come as a operating activity under the income taxes paid as 10 crores.
Operating.
Yes, operating activity. Yes.
My question is,
Yeah.
in that case, this 10 is what is paid. Right?
Yes.
You said you can classify under financing or investing activity.
Since this is a business profit, that's why coming to the operating.
When you talk about DTT,
DTT for the dividend distribution. Generally, whenever the company wants to make a dividend payment, it's in the 2-3 years back. The finance has changed later point of times. Now, the dividend is being charged in the receipt of the shareholders, not by the company.
You're telling that company cash that tax should be shown as operating activity. The same company invests in mutual funds that capital gain tax should be shown.
Provider, I have a loss, I have a profit. No, it's allowed. It's actually required. That's what standard required. But most of the companies takes the impracticable standard because they offset some things. Hence, they don't want to disclose it. So standard also says impracticable, leave it. It's always a entity's mindset, right? Why should I go and think beyond certain things rather than put a simple thing and close it out? But as auditors, we should be very, very cautious in this. If it's practically possible, make sure that the company is disclosing adequately the taxes in the respective activities, not only in the operating activities. A small example here. Okay, typically any investment company, if you go, they will subscribe for a bond or they will purchase a bond at a deep discount, right? Because I will purchase a bond on year 1 at a discount, on the year 3 it will get matured. So my actual outflow will be what is the purchase price. The standard mandates to represent in the cash flow or disclose in the cash flow only the purchase amount, not the final maturity amount. So what is the real cash flow is the cash flow payment happen on that date, how much is the amount you purchase. In this case they purchased 5,21,500, the maturity value is 25,000. So they cannot show in cash flow as a 5,25,000 because that is the maturity will come in future. The actual payment was only 5,21,500. So they have to disclose under investing activity investment in bonds as 5,21,500.
So, investment that is, it is principal business is, you said, it's not a manufacturing or something.
Okay.
It's really a company
If
basically.
it's principal business itself is like a investing company, it will form part of operating. But in case the principal business is having some sales with customers and they do treasury by investing in bonds, that form part of investing activities. It all depends on what the company is into. I'm having an example on that slide also saying that how it differs from entity, normal entities and NBFCs or banks. Okay. Here is on the forex part. I think most of the people seen that companies will have lot of imports or exports where they at the year end they will do a restatement of their debtors or creditors, right, which is based on the closing exchange rate, could be RBI rate or could be bank rate, whatever might be. So any exchange restatement happen at the year end on debtors or creditors. Generally it's a unrealized portion because you are not realized at all. So standard mandates that if it's unraised portion of forex losses, it cannot form part of cash flow. So you should be presented if it's an expense, add back in the operating activity. If it's an income, reduce it from the operating activity. Okay, here is one example. What if the company is having a asset which they sold and they got it back by way of lease? The answer is there. If it's a company and they sold the asset and they taken it back as a lease, the lease is in the nature of financial nature, financial lease. Basically, at the end of the tenure, I will be taking it back, where your lease payment is going to be for the over the value of the total asset. The period also going to cover the more or less the same period. So if that's the case, it's a financing arrangement. So anything happened on that part, it should come under financing activity. So the company sells asset, take it back as a lease. The lease is financing nature. It has to go under financing activity. If it's going to be an operating lease, I am not going to be the owner after end of the lease term, or the lease term is not going to be the maybe for the shorter period. If it's operating lease, then it will be nothing but I am just selling the asset, selling the fixed asset, whatever might be. It should form part of only investing activity. Yes. Basically, when you sell a fixed asset, it's form part of your investment activity. Okay.
Fixed asset portion also should be from investing to financing activity. That's what you are telling.
In case if I sold the asset, I am taking it back as a lease, which is a finance lease. Then it's a financing arrangement. It's not an operating lease arrangement. So that should form part of your. It's like you are getting a fund. It should form like a borrowing. So it should form part of financing activity. Typically the asset sold is same, but I am taking it back as a financing.
Just like a long term.
Correct. No, long term, short term, whatever might be, it's a financing activity.
This is going back to your fourth previous one.
Yes.
Where the tax and distributions are paid by this time period.
Correct.
So for example, 3 years is whatever income is
So you're saying TD is deducted on certain incomes.
certain incomes could be operating as well as even investing. So that also will be that will be only during that period. Actual tax will be operating period after.
So for example, I give you example here. I have a business income, I have investment income. For my investment income, say I have a FD which I got interest income, with the bank would have deducted 10% TDS, right? So I have a business profit, I have a interest income which is an investment income for me. If there's a clearly practically possible that this, actually speaking, investment income also forms part of your business nature. So that's why the companies will go and put it as a operating activity. I mean, taxes whatever they paid on investment also under operating activity. But if it's a shares or a other items, if it ends up with the capital gains, then you can really carve it out.
As per investment act,
Yes.
the term loans changes, that will come that is increased term loan.
Okay.
That one on equity, in financing it, long term. Both will come in the financing it.
Yes, if you have anything on the equity or borrowings, it will be financing activity. I think the answer one of the member already said, any changes in the working capital movement forms part of operating activity.
Just one slide before where you said that sale and lease back. So
Yes.
the exception is when you normally sell the fixed assets, it will come as part of your investment activity as a sales process of your.
Correct. Because I am selling the asset, I am just taking it back as an operating lease.
So if you are taking it financially, then it forms part of financial.
Substance of the form is I am selling the asset, I am getting a funding for it. That is why I am taking it to financing activity.
Asset financing.
Exactly.
This finance is arranged, it is not LC. If it is operating, it's a LC. That's the example.
Correct. I have one example here. Maybe just read a bond. The entity purchased a 2-year bond, which is a bond in the market, the open market, where the bond only has 3 months remaining before its redemption date. So this is a cash equivalent as per Ind AS 7.
As on date, there is no.
No, the company has purchased the bond, the day one, the 3rd month end it's getting redeemed. So the maturity period on the date of purchase is 3 months. It should come. It should come. Any answer for no?
In the balance sheet, it says original.
This one, that's one acquisition trade.
Yeah, that's right.
But this one,
So you're saying no, sir?
execution of data.
Okay, it's maybe. Okay. It's actually a tricky thing that you will not form part of yes or no. Right, right.
Really, I don't know.
Right. As its answer is the date of acquisition is what matters. From the date of acquisition, please look at the maturity period. Don't look at from the balance sheet end date. Most of the people or most entities make some mistakes, sir. On 31st March 2025, okay, I have a FD which is going to mature in April or May. They will take it as a cash and cash equivalent. If you look at the original maturity, basically that fixed deposit have been taken in the April 2024. It's a period of 15 months. So cannot be formed part of your cash and cash equivalents. But if in case that FD is taken on 31st March is going to mature in the May month, it's formed part of cash and cash equivalents because on 31st March the maturity period is only 2 months.
So I will change it to this starting first of May.
From the date of acquisition, look at for the maturity period.
So suppose if you bought in February 1st,
Okay.
and it has the maturity for the right?
Obviously, it's a cash and cash equivalent because once again 2 months from the date of acquisition. Okay.
So up to 3 months cash and cash.
Yes, from the date of acquisition.
Beyond 3 months,
Beyond 3 months, it will form part of your investment activity. So that's why tricky. It should form part of either operating, investing or financing or under cash and cash equivalents. You have to be very clear which form part of cash and cash equivalents, operating, investing or financing. I think this also is very easy. The 2-year bond, same bond, have 4 months remaining maturity on the date of acquisition. What happens? Is it cash and cash equivalent? Yes or no? Great. Same question, little tricky here. Same thing. The 2 months from the date of acquisition, but it says the purchase is made for investment purpose. Is the answer going to be yes or no? Any no's? No. Why is it? True. If the define that it's mean for investment activity, then it takes the color of the investing. It cannot form part of cash and cash equivalent. I think here one tricky one here in the standard says restrictions. There is a group operates in India, there is a subsidiary operates in Singapore or in Iran. Due to the war situation, Iran cannot pay any dividends back to India. So there is a restriction by the government of Iran that no funding has to get out of the country of Iran to India. So no repatriation, yes, either by way of dividends or not by way of your equity coming back. I think impairment is the next topic which my colleague is going to take it up. That's going to be another very good session. So whether we can disclose that item in the consolidated financial statement as a cash and cash equivalent. Okay, the answer is yes, because consolidated financial statement as per Ind AS 110 says that subsidiary entity for them it's a cash and cash equivalent. So when it comes for consolidated, it's a line by line addition. You should disclose even though there is a restriction on by the government. Now comes the next item. This is a very tricky question. There are certain investments like I have unpaid dividend account. If you see listed companies, there are a lot of unpaid dividend accounts and some share application money and redemption dividend, legal restrictions. Is this form part of your cash and cash equivalent? Fantastic. I think people all got the answer. These are purely restricted, hence cannot form part of a cash and cash equivalent.
Less than 3 months also.
Doesn't even 1 day, less than 3 months, no, because these are restricted cash balances. Exactly. Correct. Okay. So considering the time, I'm just going to take few more things. So we have typically 3 types of investments, right? I have investment in subsidiary, could be associate, could be joint venture, could be joint control. What is the presentation point from the cash flow perspective? If it's an investment in the subsidiary, take their cash flows as your cash flows, present it. If it's an investment associate, which typically Ind AS allows only to follow equity method, then take their investment in the investment activity. Anything gains or loss comes from that associate or joint venture, please put it under investing activity. If it's a joint control, please, the standard says that it should take the percentage of the share, how much it takes in the respective activity. Coming to the accounting policy, just as per Ind AS 1, it mandates the company to classify the accounting policy for the cash and cash equivalents, either in the treasury part or somewhere in the accounting policy or somewhere in the financials to put up the accounting policies. And one amendment came later, the Ind AS come into picture that in case the company has lot of items in financing activity, in financing there are certain non-cash flow items. So this amendment brought by MCA says that there should be a reconciliation item for the financing activities alone. Say for example, I have a loan taken, I have a hedge taken for the loan. There will be hedge which is not been closed, basically derivative instrument I taken. So I restated the borrowings at the year end. So if you typically look at the borrowings will be always on restated balance at the balance sheet, but there is a fair value gain or loss or MTM gain or loss on the hedged instrument. So this MC amendment brought it that in case of any non-cash flow items in the financing activity, it has to be disclosed separately by way of reconciliation. That is amendment. Okay. Quick example. I am going to touch upon the banking and the other entities, other than banking and other entities. What is the interest received on loans and advances? Super. And for other entities? Fantastic. Similarly, interest paid on deposits? Wow. And for other entities? Financing. Okay. Fantastic. What about dividend received in the investment in bonds and shares? Investment. For even for banks? So one member says part of the operation, so should form part of the operating. Other member says it's form part of the investing. Any other view? Typically for a banking companies, the investment is based on the RBI norms. They have to go for minimum deposits with government bonds, common things, a lot of regulators. So it forms part of the operating activity. How about interest and dividend received on investment in subsidiaries or associates, whatever might be? Investing for banking also? Fantastic. Yes, irrespective, either banking or normal, not a banking company, standard mandates that if it's investment in subsidiaries, it should take the color of only investing activity. It cannot take a operating activity. Similar dividend paid on equity or preference shares. Financing activity. Fantastic. Yes.
Interest received on loans or interest paid on deposits. Since the parent, it is nomenclature of raising loans or repayment of loans is coming and financing. That's why interest also coming.
See, you are talking for banks or for parent company?
For a general company.
General company, if it's interest paid, interest income is purely investment activity. So we will take it out from operating, we will disclose as a interest received in investing activity. See,
Interest received on loans for other entities, I believe.
correct,
Investment activity or
correct,
correct. It's a treasury. Interest paid on deposits and other borrowings.
right.
It is written as financing.
Because the deposits what we are talking is paid, sir. This is not received. I have a public deposits as entity, I need to make interest payment to my public. I have borrowings with my banks, I have to make a payment to the banks. So these are the typically borrowings. So it should form part of financing activity. Anything pertains to my equity or borrowings, it takes only in the financing activity. Yes, sir.
You say dividend received on interest of bonds and shares.
Yes.
You say it is an operating activity. For banks.
Banks, sir. Only for banks.
Only on statutory requirement.
Correct.
Only on statutory.
Statutory part.
If I go out of the way and do some other things.
Typically that's also a judgment call, sir, but standard says that for banks it's mostly statutory requirement, it should form part of the
It is statutory.
operating. Yes.
What about treasury income for banks?
So that is treasury.
It's operating.
So treasury means you are saying that I will invest in mutual funds, I will invest in things. Those should take the color of investing because that's a treasury part. That's not their core business. Please understand the core business income has to go to operating.
Third party.
Yes.
Banks, other than statutory investment, would it be classified as?
That's what I'm saying, sir. In case the banks invest in mutual funds, they buy, sell, that not form part of the core business business of having a loans given, loans taken, it form part of investing activity.
Wherever there is a deployment of excess cash, you are saying you can investment.
Correct, correct.
More of this.
Yeah, slightly on a small difference between the Ind AS and the IGAP. 3 items I can say. Bank overdraft we all touched upon. Bank overdraft in IGAP clearly states respective order might be, it form part of your financing activity, whereas if it's cash management of the Ind AS company says repayable on demand, it should form part of the your cash and cash equivalents. Similarly, from external items, there is no concept of external items in Ind AS, hence does not require any separate disclosure. However, in IGAP there is a requirement, it should either come under operating, investing or financing based on the external item. And acquisition and disposal of property sale for rental, so there are no specific guidance, whereas in Ind AS it says that it should form part of operating activities if the company's activities just go acquire and sell off based on rental part.
Sir,
Yes,
bank overdrafts in case of Ind AS.
yes,
Debit balance in the OD.
Correct,
This is cash debit. That's
generally
net of-
debit balance in the OD will form part of your cash and cash
Net
equivalents.
of the cash.
It's form part of your cash and cash equivalents.
Suppose cash is more balance, both will net off function.
No sir, cash and hand, debit balance of bank, debit balance in current account, debit balance in demand deposits, all will form part of cash and cash equivalent.
Including the overdrafts.
Yes. Yes. Okay. This is the last two slides I have. I'm going to end after this. So incorrect, this is the pitfalls in the sense that the entities make lot of mistakes or they take a lot of, I can say it's the errors in the presentation. This is one of the study being conducted by one of the foreign institute and they picked up these are the errors being highlighted at the global level. Incorrect classification of movements in certain restricted balances which were included in financing activities. So there is a restricted cash balance. Ideally, where should be disclosed? Like your unpaid dividend, I have a fixed deposit which is marked with lien or guarantee with mark. These are restricted balances. Where should be form part of this disclosure? It's operating, financing or investing. Certain restricted cash balances, sir. Please keep in mind, this is a cash balance. It's not a borrowings. Unpaid dividend account is not a borrowings.
You What is it like credits?
It's a debit.
Bank guarantee.
I have a fixed deposits, but fixed deposits is marked with a lien or a guarantee, which is restricted, where I will disclose. Most of the companies are wrongly disclosing under financing. What is ideal disclosure?
Investment activity.
Exactly, sir. Because these are typically investing activity. What?
Fixed deposit, sir. You said in this case now. What is the period of more than 3 months or what?
Okay. So right question. If the fixed deposits, I have a guarantee or a lien, whether I take for 1 day, I take for 1 year or for 3 months or 9 months, it is a restricted balance, cannot be a cash and cash equivalent. It should be only investment. If it's a lien marked against the FD, it is a restricted cash. Restricted cash is not a free cash, hence cannot comes under cash and cash equivalents. So keep the substance.
You
Yes.
will show the investment activity outflow.
Yes.
Outflow.
Exactly, because I made investment, I need to pay bank, so it's outflow. So what about this purchase of business incorrectly classified as operating activity? So they wrongly shown under operating activity. There is a business purchase happened, where it ideally should be present in the cash flow. Fantastic. Answer is where? Investing only, no? Super. What about cash flows leading to the joint venture funding? So parent company, they are funding the joint venture. Wow. I think people are excellent in say it's a financing activity. Sorry, investing activity. They wrongly disclosed as financing activity. And post acquisition and restructuring cost. Basically, I made an investment or I bought a business. I am incurring certain expenses after that. Where it will be disclosed? The company is wrongly disclosed as investing activity. Ideally, where should be disclosed? Any expenses incurred after you bought. Fantastic. It's operating activity. I think this same thing repeating here. I think same thing. Acquisition related expenses, anything, it should be on part of operating. Yes. Here the company has a debt. They have a borrowing. Okay. Which is a promissory notes, and it was wrongly disclosed as a operating activity. Where would be the ideal disclosure? Fantastic. And restructuring part, I have a restructuring cash outflows, which was incorrectly classified as investing activity. Where it should be? Financing. Because why sir operating? The answer was here. Basically, any restructuring happens after that, it's typically operating nature. I think I covered.
Any restructuring?
Yes.
How do you clarify that? Say, previously it would have been.
This one, sir. Sir, you're saying something.
No, last to space.
Okay.
Previously wrongly classified.
Yes.
Now you can classify only in operating.
Yes. It's a restructuring part. If I do any restructuring, it is investing. So it's basically a cash outflow on investments, other items. I think any questions? Okay, thank you. Thank you.
Thank you, Balachandar. Okay, before our next session, we have tea. Important announcement is you have to sign your attendance. Okay, post lunch session, unless you sign, you will not get your CPE. Make sure that you sign, and we will reassemble at 4:05. I request CA Mr. Purushottam to hand over a small memento on behalf of SIRC. A brief introduction about Ravi. Ravi brings in over 7 years of professional experience in audit and assurance. He has successfully led audit teams across sectors including power, manufacturing, construction, automobile, marketing, MLM, delivering high quality assurance and regulatory compliance solutions. He has traveled extensively. With this short introduction, I hand over to
Good evening all. Warm welcome you all to this session on impairment. So thank you for this opportunity first of all. So we are going to look about impairment of assets. So what is this assets? It is dealing with what assets? All assets or? Perfect. Intangible assets then? Only intangible assets, fixed assets, property, plant and equipment, that's all? Debtors, okay. Loans and advances, okay. Sorry? Inventory, okay. Investments, okay. To set the context, Ind AS 36 addresses only non-current assets, right? Property, plant and equipment, intangible assets, and goodwill, right, it's coming to that. Investment in subsidiaries, joint venture and associates. So these are the only inclusions. So all others are excluded. Example, inventory and trade receivables, all of them are excluded. It is not within this ambit of this Ind AS 36. So it is in the ambit of Ind AS 109 or 11 standard. For example, inventories, it has to be carried at NRV or cost, whichever is less, right? So
what about investments?
yeah, investment in subsidiaries, joint ventures and associates is covered in this standard. Right.
Investments are not.
Correct. So my next question is, what about investment property? It is included?
That is covered under different standard.
Different standard. Okay. Any other thoughts? Investment property, no, on rental income will be having their investment property in assets.
That asset comes under non-current because of part of your own operations.
Mm-hmm.
It has the it should cover only non-current.
No, investment property is asset, kind of a rental property. So impairment will be applicable on that? Yes, within the purview of Ind AS 36, you are right. So my next question comes to CWIP. What about CWIP? The asset itself not capitalized. Whether impairment will be applicable? Is it? Yes, it is included. Then what about intangible assets under development? Goodwill? These are all included. So to set the context, this is the objective. Objective is to carry at the recoverable value. Okay. So assets are carried not more than the recoverable value. This standard applies in accounting for impairment of financial asset classified as. So this is the additional thing, right? So investment in subsidiaries is dealt by Ind AS 109, right? So this is also getting covered in this standard. So I have one more doubt. Investment in preference share capital. Okay. So that you are carrying it at amortized cost under Ind AS 109. Will that be applicable? Investment in equity instruments, I understand. Investment in preference share capital, is that included under this Ind AS 36? So currently what we are doing, we are just now setting the context, we are seeing the purview, what will come under Ind AS 36. So that we can be very clear, so that we can apply the thumb rule. Thumb rule everybody knows. I just want to refresh, carrying value greater than recoverable value, impairment loss, that's all. So that's the thumb rule. So now the question is about what, how, why, right? So investment in preference share capital carried at amortized cost? The answer is yes. Okay, what happened to loans and advances? Loans and advances given to subsidiaries is included? ECL. So it is covered under Ind AS 109. So not under this standard, impairment will be applicable, all this will be applicable, not under this standard, right? So this is a clear cut. What is the scope exclusion? So it says. Sorry? Traded. Trade advance. Okay, no, it is not within the purview, no. So it's 109. So what about capital advance? Anything relating to capital? Will that be included here? So here it says, here you have a caveat, right? So what includes what, excludes, everything is here. That's all. So shares, no, Ind AS 109, not here. So capital advance will get covered here. So what we are trying to freeze is carrying value. Carrying value, recoverable value will be comparing. What is carrying value? Carrying value is the asset on which you will be performing the impairment, right? So we are freezing the carrying value. What and all will come, what will not come. That's CGU basically. So capital advance will be included in this? No. Right? So if you visualize the balance sheet, so non-current assets under this property, plant and equipment, intangible assets, ROU will come, right of use assets. Will it be included in carrying value, ROU? Because that is also an asset. Yes. So that is within the purview. Perfect, sir. Yes. So Ind AS 36 treats that as an asset and lease liability as a debt, right? So this is that caveat. These are all the exclusions which we already discussed, and these are all the inclusions. No, it is not individual asset based. It is covered in sequence slides. So what happened? How we will start with? How we have to start with? How we will come to know whether we will have to do impairment? So how many of you did impairment actually? Impairment provisions, okay. So what triggers you to make that impairment provision? Okay, so how you will come to know?
Suppose in my case, I made investments in the subsidiary.
Mm-hmm.
The subsidiary is continuously incurring the losses.
Net assets is, net worth is negative.
Even also we try to give some loans. Then also it is not there. So we thought that okay, it is to better to impair it with the carry.
Okay, perfect. Any other thoughts, any other inputs which you can help me with? Yeah. Yeah. Exactly. Exactly, sir. So what is the indicator? First of all, how do we start with? So we have to start with the indicator assessment, right? So it was read long time back, I can understand. So we have external indicator, internal indicators. So we have a list of assessments, right, that has to be carried out. What is indicator and indicator assessment and what is test, impairment test? Difference between impairment indicator assessment and impairment test. Yeah. If there is a trigger, then we'll go for test. Perfect. So what are all the other, see logically if you think no, how you will get to know there is an impairment? What is impairment? Just to reduce the value, right? So to reduce the value just like that we will not do. So that while seeing that we could able to sense it out. For example, we are doing our site visits, right? So you are seeing that windmill is not operating. Directly you can go and ask, right? So in that way it is operating. This windmill is not operating. So it is not generating any revenue. It is damaged asset. No revenue for more than 5 years. So then impairment. So is it like case to case basis? Kind of inventory. If it is damaged, then provision has to be created. Is it that way? Perfect, sir. So there is scientific method has been suggested by Ind AS 36. So it is not like asset wise. So they are telling with value in use or fair value less cost to disposal, whichever is higher. If you have a plan, how much you will be going to generate cash flows. Okay, so with that, whichever is higher, that is your recoverable value. It is not case to case basis, but for case to case basis, what you can do is you can change the depreciation method, you can change the useful life, accelerated depreciation, that you can bring it. So that is another option that we have some illustration surrounding that you can see. So assess whether there is an indicator of impairment at the end of each reporting period. So what is reporting period? Year end, right? For listed clients, quarter end, that's all. For listed clients, each quarter, whenever you draw a financial statement, we will have to do an assessment, indicator assessments. So we have internal indicator, we have external indicator. So based on experiences, what and all you can tell as an indicator for impairment? As sir said, negative net worth. And then what else? Outdated technology, perfect. Yeah, because these green products are coming in. Drop in sales, yes. So in gross level, you are making loss. So there is a gross loss, typically, right? So that can be considered. So net loss, I understand. Okay, gross loss you are having. If you book a purchase order, okay, so you are booking a loss indirectly. You are purchasing at 10 rupees, okay, you are selling at 8 rupees. So it indicates, right? So these are all the indicators of impairment, external sources, and indicators of impairment, internal sources. So associated examples are there. What you said, that is what is there in the slide. So is it the exhaustive list? It's not the exhaustive list. There is no hard and fast rule in impairment. So everything is based out of judgment. So you know about the client, how it works, how it operates. So it's a professional judgment. So just they have given some indication, some guidance they have given how to deal with indicators of impairment surrounding external and internal sources. So wherein that climate changes impact carbon taxes and changes in consumer demand. So these are the example. And asset become idle. So these are the indicators. So when we do a site visit, we understood there is some machines are no idle. It's not generating any revenue. So what we will have to do? So this is an indicator. We will have to start doing that, value in use. So there is a trigger for indicator. So we will have to do the indicator assessment. And actually it has to be done by the management. Basically it's a management review control. So management, the top level management has to get involved into this, and they will have to do detailed analysis, and they will have to conclude on this. So as an auditor, we have to insist on this. What happened to that? What is your review? What is your assessment? How we can conclude on this? So that's the key. So okay, so that's what it's written. At a minimum, we will have to do this indicator assessment. In addition to that, based on industry, based on sectors, so there are new regulations are coming in, and there are a lot of compositions has been levied. So if there is a trigger for impairment indicator, then we will have to do an impairment test. So to do an impairment test, what we need? Very simple. We need carrying value, we need recoverable value. So what is recoverable value? Recoverable value is the cash inflows, value in use. And fair value less cost to disposal. So if you have an asset, right, so we can go for fair valuation. So they can do the fair valuation and they can tell you. So fair value less cost to disposal, it has multiple methods are available, like replacement cost method or discounted cash flow. There are scientific models are available. With that scientific model, you can freeze the number. What is the fair value less cost to disposal? So the other method, value in use. Value in use is, sir, I have this much plan, sir. I will be doing that, I will be doing this. So they will come up with a plan, client. Okay, so I will be generating this much cash inflow. I will be having this much cash outflow. At the end of the day, I am having free cash flows, discounted cash flows, right? So that you will be seeing, you will be doing the present value of the cash inflows basically, and you will be comparing it. Fair value less cost to disposal and value in use. Whichever is higher, that will be your recoverable value. And carrying value is the CGU. So that is what we see now. So we seen 1000 feet level, like non-current assets, property, plant and equipment. So those are all 1000 feet level. If you drill down, you will have to bifurcate that assets into different CGUs. So cash generating unit. For example, you take an example of Reliance. So they are having multiple outlets. So each outlet is CGU. So in each outlets, what and all you are having? So you are having the office equipment, you are having the furnitures and fixtures. So you are having some basic machines set up over there. So it's a combination of different class of assets will be taken as one CGU. Is it mandate to have only one CGU? Is there any limit to have maximum CGUs? No such way. So how CGUs has to be taken, how it has to be grouped? See, whatever has been done, it has to be done in consistent. The classification, the grouping, what we do, unless there is a trigger, it should be consistent. So in that way, we will have to keep it. So in CGU 1, 2, 3, 4, you will have to allocate. So basically, each CGU, you could able to identify the cash inflows surrounding that. CGU 1, what is the cash inflows? 2, first we will do individual asset wise. If I can able to generate cash flows based on each individual asset. If I can't able to do, then I will go for CGU. Okay, I will add 2 to 3 assets. Then I will see whether I could able to make a direct association for the cash inflows. Still I can't able to do. Then group the CGUs. That is what it is written. Group of cash generating units. So then what we'll have to do? So goodwill has to be allocated to the CGUs. So this is a mandate. So is there any option? There is no such option. Goodwill has to be allocated to the respective CGUs. So there is definition, a CGU is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So this is the definition about CGU. So this is what we've seen, higher of value in use or fair value less cost to disposal. So cost to disposal means like incremental cost associated towards dismantling those charges. So as on date, what is the fair value of the asset? So when we will generally we will assume fair value less cost of disposal to be a book value. Okay. So generally we will not go for any valuation at all. So we will take it whatever is there in the balance sheet historical cost, that we will take it, and we will do value in use practically. So on what scenario you will go for fair value less cost to disposal, that valuation and all, it has to be done by the registered fair valuer. Any thoughts on this? When we will go for fair value less cost to disposal? Usually we will assume book value to be the fair value less cost to disposal. When we will go for fair value? Okay.
Then we can see the fair value and that time we can take
If yeah, for that only accountant will do all this analysis and they will come up with this. So fair value, if management has planned to dispose, then it will go under Ind AS 105, discontinued operation. That is not within the purview of Ind AS 36. Anyway, that has to be carried at fair value, I agree. So you don't have any business. Okay, for example, you have one very big customer. Okay, that customer is giving you 10,000 crores, 12,000 crores. Assume you are a contract manufacturer of that customer. All of a sudden, there is a cancellation of agreement with the customer. Okay, so you don't have a business at all. So then you cannot go ahead with the projections, right? So in that scenario, we will be going for fair value less cost to disposal. So fair value they will be doing replacement cost. As on date, if they sell this asset, how much they will fetch. So that they will get some report. So these are all the different methods of fair value less cost to disposal. Comparable companies, multiple discounted cash flow, relief from royalty, replacement cost. So these are all the cost of disposal. This is how it will be calculated. And higher of this will be recoverable value. That's all, it's over. Impairment scenario is over. Carrying value greater than recoverable value. Okay. So to do deep dive on this, sir, in value in use also we are having cash flows, right? Fair value less cost to disposal also, there are 4 different methods, A, B, C, D, right? In that second one, if you see discounted cash flow, what is the difference between these two? In value in use also we are having cash flows, no? Okay. Not exactly. So, but to an extent, so both are same. Okay, in value in use is a disciplined method wherein you have a specific rule set, what to include, what not to include, right? And fair value less cost to sell. See, value in use is one more important thing. When you do this value in use, you have to do an analysis in the existing form of asset. We cannot shoot in the air. Like, sir, I will be deploying 50 crores, 500 crores ka asset, I'll be generating 2,000 crores ka profit revenue. That projections and all we cannot, it will not sell through, right? So, it in the existing form of asset, இன்னைக்கு என்ன இருக்கு, right? இந்த asset வச்சு with some replacement, how much you could able to generate in next 5 years. So 5 years is given in standard. Maximum projection period is 5 years. 5 years க்கு மேல பண்ணலாமா projections? Can we go beyond 5 years for projections? Huh? Again, there is no hard and fast rule. It's a judgment. It's a judgment, and we will have to justify that. What is the judgment we will have to justify in the documentation? Yeah, that are also another factor. The other rationale would be like PPA agreement. You have a contract agreements for next, yeah. So next 15 years you are having some agreements, 25 years you are having agreements. So you are having contracted cash flows. So that gives you guarantee, okay, this much cash inflows will be there. Yeah. Yeah. So you have some backup or base to say, this is how it works. Okay, I have backup to say this. So can include, so no restructuring, expansion, enhancement in value in use. Whereas in discounted cash flow, we can do the capex expansion. So that's a key change. In the existing form, you can do repairs and maintenance to the assets. But you cannot plan something, new asset I will purchase, this is a new business, new plan, those things it will not sell through. So in the existing form, for that only we are performing an impairment analysis. If on a DCF basis, discount rate may be higher than for VAU. So here it is conservative. Since they are allowing so much, there is no rule set, and they are allowed to do a lot of things. So here discount rate is much higher, but value in use discount rate from a perspective of owner, lower size of premium, and should be performed on multiple approaches, should be cross-checked, total VAU to market capitalization, implied EBITDA multiples. So these are the key differences between value in use and discounted cash flow. So now we understood what has to be done and identifying an asset that may be impaired. So this is a snapshot. So we can just see, so it's a bird's eye view. So overall the process in which impairment will happen. First we will be seeing asset impairment condition. So evaluation has to be done by the management. They should have a control. They should draw a projection. So the projections, they cannot shoot in the air simply 5,000 crores, 10,000 crores. So they should have done some capacity utilization analysis. They should have done some trend analysis. Last 5 years, what you promised, whether you did that or not, that question we will have to ask. So simple, last 3 years projection you will have to see. Retro analysis, projection versus actuals. Last time you projected 100 crores, you landed with 4 crores loss. What is the reason? So it's inefficient in projection, right? So incompetent in projecting the balance sheet. So we will have to understand. So every year it is operating this way, then we will not get a comfort, right? So there can be deviation. projections can be deviation to 10%, 5%. So that haircut adjustments or experience adjustments can be done, but it cannot substantially deviate. So that's the key. So impairment condition exists, then identify assets or CGU. CGU, we will have to allocate the CGUs. So for each CGUs, different cash flows will be there. Discount rate, what about discount rate? Discount rate plays a crucial role. So it can be same for each CGU, or it can be different, or it has to be different. Perfect. It can be, it depends. So based on the nature and circumstances, so if you find it to be something risky, you can adjust in discount rate. So risk premium will get added. So identifying asset, determine recoverable value, carrying value is greater than recoverable value, then impairment provision. So follow up with the management for annual review. So if carrying value is not exceeding recoverable value, no impairment provision. So higher of fair value less cost to disposal, value in use. So that has to be taken. Binding sale agreement, active market, best estimate. So these are all the ways in which impairment has to be calculated. So stepwise flowchart has been given, projected. Then it comes with indicators of investment in subsidiary, joint venture or associates. Carrying amount of investment in separate financial statement, simple. What is the investment which I have in subsidiary and what is the net assets? So what we have to be cognizant, what we have to be cautious about it is, what is the percentage of investment? 60% you have invested, 60% of net assets only you have to compare to analyze for impairment, right? So similarly, if there are loans given, can we add that or not? I have investment in subsidiary A, 1 lakh rupees I have invested. I have also gave loan of 10 lakh rupees. My carrying value will be 10 lakh plus 1 lakh or only 1 lakh. No, 10 lakh impairment will be doing separately, but as per Ind AS 36, carrying value is only 1 lakh. Yeah. So as per Ind AS 109, we will be doing the loans impairment analysis separately. And we will be comparing it with the net assets, and again that we will have to draw a different conclusion. But it does not impact actually. So if you see, if you compare net worth, no, what is net worth? Net worth is asset minus liabilities. In liabilities, whatever you gave loan, that will be sitting as borrowings. So it will be nullified. So it's a kind of a elimination adjustments. So there will not be any impact even if we do that also. So basically investment will have an impact, and dividend greater than total comprehensive income of investee. So in the consolidated, if this criteria has been met, then there is an indicator. So if there is an indicator, we will have to do analysis. So with respect to subsidiary, then subsidiary is audited by other auditor. Okay, can we take that comfort? No, right? We cannot take that comfort, because now CCD cases and ISA 600, ISA 600. So entire responsibility lies with us. So even NFRA, everything, whatever valuation report you are relying on, everything. So we will have to read the caveat in the valuation report. So what he is doing, why he is doing, how he is doing, everything we will have to see. What input he is taking, what discount rate, why he is taking, what is the source, what is the risk premium he is taking, what are all the comparables he is taking. So for unlisted companies, he will not have beta. That for that beta, how he is taking. So he will be doing the comparable analysis, kind of a TP. So NFRA is asking question like, why you have taken this comparable? That assessment is not there. So they have given one such deficiency, one such query. So they are going in that depth analysis, right? So 10 comparables they have identified, and they have taken, why you have taken only this 10? Why not other 10? Is there any specific reason? So you will have to see the comparable industry benchmark in your industry, for example, power sector, for example, automobile. So in that industry, what is the benchmark? What is the beta? So listed company ka beta you can see, and you can do unlever and relever. So based on your capital structure, like same like transfer pricing adjustment. So we will be taking that, and we will change that leverage aspect, and industry proportionate leverage we will take it, and accordingly discount rate has to be arrived. So all this exercise would have been done by the valuer. So we will have to analyze competent and his relevant experience and his capability. He is good at this industry, so he is having relevant experience, number of years of experience, and we will have to document how the input was taken, how he has arrived this conclusion, why not other beta. So these things has to be detailed. So considerations of identifying CGUs has been given. So this I am skipping, this we already discussed. And VAU calculation, so these are the rule set for the value in use calculation. So as we already discussed, value in use is nothing but the projections. So projections we have two things, business assumption and we have valuation assumption. Valuation assumption is kind of a discount rate associated to asset. That is what we discussed now. And business assumption. Business assumption, what is his capacity, trend analysis, that we have discussed already. And why he has taken this much revenue. So current year the revenue will be 1,000 crores. The next year he would have projected for 5,000 crores. Because there will be a discount rate impact. So next year cash flow will be advantage to them and compared to the second year, third, fourth, fifth. Right. So in that way there will be impact. So what is the basis we will have to question? Like do they have any sales order, any agreement, any backup for the supportings? How this all of a sudden this much sales has been done? And we would have started the audit in the month of May, June. Okay, so this 3 months, is there any communications, email communications, any samples they have got it? So in that level, the revenues and the GP analysis, so NP analysis with the trend analysis and look back analysis has to be done, and it has to be taken because that is the input which we are keying in. In value in use calculation, the major input is your projection. If projection is wrong, you will get a wrong answer. Correct. So projection has to be accurate and GP margin, everything has to be consistent. Last 2 years, last 3 years you take, same trend, same thing has to be applied for the another 5 years. So there should not be any cost related savings and all. So this much I will be saving. So those adjustments should not be done in value in use calculation. And lease liabilities outflows should not be included because it is considered as a debt, and exclude future cash flow that are expected to arise from improving or enhancing an asset reperformance. Exclude cash inflows and outflows from financing activities and income tax receipts and payment. So what discount rate we will have to use? So whatever you use, it has to be consistent. Apple to apple comparison should be there. Pre-tax discount rate, you have to take pre-tax cash flow. Post-tax discount rate, post-tax cash flow. So in that way, if you take, you will get same answer. Whatever we do, we will end up with the same answer. So, but as per the Ind AS 36 disclosure requirement, we will have to give pre-tax rate. So that is what has to be disclosed. But we can use post-tax rate also, provided post-tax cash flows has been considered. So terminal growth rate. What is terminal growth rate? After 5 years, so perpetuity impact they would have been given. So what is the growth rate, terminal growth rate, how they can assume that? Just like that, or 20%, 30%, not possible. So there is a guidance given. So it should be maximum of product, industry or country's growth rate, and it should not exceed this long-term average growth rate of these three. And it has to be negative or constant growth rate. Year on year it cannot be increasing. So this is the maximum growth rate can be considered for the terminal growth. So goodwill impairment, goodwill needs to be grossed up for NCI interest if the initial recognition of goodwill basis excess purchase consideration over the investor's proportionate share of net assets. So if there are any impairment loss, first it has to be allocated to goodwill. So goodwill has to be allocated to CGU and it has to be identified. So this is the ROU asset. ROU asset should also be included, and VAU projection, value in use projection, should no longer have outflows for other cash flows on balance sheet as liability. So discount rate need to incorporate cost of leasing debt. And these are the climate change impact which has to be considered in value in use if there are any. So I just want to give you the snapshot of the impairment calculation. This is how we'll be doing impairment test. First we'll be taking the profit for 5 years. So how it has been calculated, the revenue, expenses. So if you see -2, -1 is the previous year, and 0 is the current year, and next 5 years has been projected. So in these projections, these are all the adjustment. The key adjustment is the working capital adjustments. If there are any working capital adjustment is a key, usually people tend to miss this working capital adjustment. So this is mandatory. Then only it will be apple to apple comparison. Working capital adjustments are very simple. Inventory, trade receivable minus trade payable. This is your working capital adjustment. So that you will have to project it for the subsequent 5 years. So once you do that, you are having revenue and expenses, you are getting EBITDA, depreciation, tax, income after tax, then adjustments, working capital adjustment, then you are getting free cash flow. Our objective is to get the free cash flow and discounted at the discount rate, whatever the rate has to be, 14%. So that has to be separately validated. These are valuation assumption. And if you do that max, you will be getting the enterprise value. So that has to be compared with. So if you see the assets in the summary, so these are all the non-current assets, brand, plant and equipment, ROU, other assets. So property, plant and equipment, everything has been included. Total CGU. So they are considered to be only one CGU. They don't have multiple CGU. So simple business. So their CGU is 1378 and enterprise value is 1418. So is it a headroom or impairment? What is headroom means? You are having extra cushion. There is no impairment, you are having cushion. So that's the headroom. So here we are having headroom or impairment. Why?
Because the enterprise values.
So that's your recoverable value. Enterprise value is the discounted cash flow, total of it. Total of 5 years ka discounted cash flow. And the CGU is the carrying value. So we are having headroom here. Is it good to go? This headroom 41 million is fine. 41 lakhs or 41 million. So there should be enough headroom. If something goes wrong, okay, it will be dicey. You will end up with impairment. 41 is very less number. So you will have to compare it with your materiality. You should have some sufficient PM or materiality towards it. And you should be less than that performance materiality, at least the lower level of performance materiality. We call it as CTT. So it should be in line with that. Because if we have this much headroom, when we do sensitivity analysis, it will get triggered. We will have an impact. If you change discount rate by 0.5%, 0.1%, somebody comes and challenge you why you have taken 14.5. It should have been 13.5, or it should have been 15.5 or 16. Sorry, if you increase the discount rate, you will be in a comfort zone. So it should have been 16. So then your headroom will go, impairment will be there. There will be a misstatement, right? So these are the key assumptions: validation of working capital adjustment, ensure consistent use of inventory turnover ratio. So this working capital adjustment plays a significant role. So this is a significant assumption. What I noticed is accountant has given inventory turnover ratio to be 2 in the first year. To subsequent years he has given 3, 4, something like that. So you just cooked that number, okay? So it has to be consistent. How the turnover ratio, or how the inventory is projected. So we will have to see last 3 years ka average inventory turnover ratio. That we will have to apply, and we will have to derive the inventory. That is how the projected balance sheet has to be drawn, based on which only your working capital adjustment will be there. And then appropriate consideration of working capital adjustment. Confirm working capital adjustments are accurately reflected. And then capacity utilization, revenue and GP margin should be consistent. And if it is not consistent, we will have to make some adjustments. So historically they are not meeting their projections. We will have to do some haircut or experience adjustments. So for example, he is giving 1000 crores projections every year, but he end up meeting only 600 crores. Okay, so next time if we give 1000 crores, we can directly make that to 600 crores and do the calculation. We can go ahead with that. Sensitivity analysis has to be mandatorily done for all the assumptions and conclude it is not material. And valuation approach. So in valuation approach, we will have to document towards the discount rate, growth rate, terminal value assumption, sensitivity analysis, and review of beta calculation, expert involvement, external benchmarking. So industry benchmarking, how the trend analysis is being done. So these are all the key factors. So company has to analyze. If you have a goodwill, no, you need to do analysis. Goodwill has to be tested mandatorily every year, impairment. So this is a CAM matter for listed companies. So that has to be evaluated. It is not case to case basis, it will differ. So industry benchmarking has to be done, and evaluation of key assumptions is the key thing. So what is the input assumptions, leverage ratio, risk-free rate, risk premium. Even though it is done by the separate valuer, so we will have to revisit on this, and we will have to check with that. Yeah.
I just have a question regarding this.
Yeah.
Say, for example, I'm the retail business.
Mhm.
And the cash generating unit is the retail outlets or wholesale outlets. And say one or two of those outlets, I'm trying to get an impairment. I have an impairment trigger, say a metro work is happening, or something has happened, and people are unable to access the so much cash generating unit. So in that scenario, the same cash flow approach will be done, or how will you arrive at, because it's a leased asset, it's not an owned asset. So how will you do in that case?
Similar example, same thing what we discussed now. So forget about it is no leased assets, that is asset, ROU. Okay, you will have to see the recoverable value. Next to 5 years projection you will have to see.
I will have locked in rentals. Say I have 8 year locked in rentals. If I breach it, I have to pay damages. So that will be my committed outflow. And say I'm projecting there is no realizable value there.
So you will have to project 5 years ka cash inflow and outflow. So you will have to see value in use. You will have to compare these two, carrying value and recoverable value. If there is impairment loss, you will have to provide it for. Additionally, if you feel, okay, so accelerated depreciation has to be given, or remaining useful life has to be changed, depreciation method has to be changed, that you can do that.
The remaining useful life in this scenario I cannot do because I
Yeah.
are locked in.
Yes.
So the outflow is going to be the same if I use it or don't use it. So yeah, I mean, may say it's going to take 2 or 3 years. The remaining 2-3 years of rental I might have to discount as outflow, and whatever the probability.
Exactly, exactly. So
administration
some administration charges and some security charges. And if you have done some furniture fittings for interior decorations, I think
sorry, sir.
so going back to his example, so he's not going to have a business with a particular branch or a particular retail outlet. Okay? So whatever the investments he made towards with furnitures and fixtures, because he's going to take another 6 more years to get the shops out of the permanent business has to be established. So in such a case, I think the entire investments on the areas and whatever the market bid of rentals and whatever the direct and which business, I think it has to be charged for this.
Yeah.
Do the test itself. That's what my.
But again, it's a judgment. So every year we cannot provide impairment. So if you are providing impairment, it's a one-time activity. It should not be a recurring activity. So professional judgment is involved. So we will have to really look into it, whether we are treating that as a CGU. That is the heart of the business. That is not there, no cash flows. Then we will have to go for it. Whenever there is a trigger for reversal, then that time impairment reversal has to be done. So under US GAAP and all, there is no such concept of impairment reversal. That's all. Once done. So
Percentage of the revenue, a certain percentage of the revenue should come from that asset.
sorry.
A certain percentage of the revenue.
Probability. You should have some percentage of it has to be generated.
Yeah, because I said that you have to check if it is the part of the business. So no matter multiple cash generating unit, this will be one of them.
But multiple cash generating is part of the same business, or it is a separate business?
Say I have a Reliance retail outlet. So I'll have multiple outlets. So this would be one of them.
But outlet, you can see whether this can be used in other outlets or not. If not usable, the cost involved in transferring these items to other outlets is more. Accordingly, you can take the call of
So allocating impairment loss. So impairment loss, how we will have to allocate, how we have to disclose, whether it is an exceptional line item, so that we will have to evaluate. There is no hard and fast rule. So there is no dictation. But again, if it is not recurring, exactly, sir. So if it is a material, it has to be disclosed as exceptional item. And how it has to be disclosed?
In case of investments and subsidiaries, okay, as per the disclosure norms, even in schedule, this one you have to disclose that
Impairment of investment.
Particular MP subsidiary. Suppose you are making an impairment on that particular subsidiary, obviously mandatory you have to disclose.
Exactly. So how it has to be disclosed? So you will have to rederive the remaining useful life. So it has to be in the PPE schedule. In PPE schedule, after depreciation column, you will have to put a column for impairment, and impairment has to be allocated. How it has to be allocated? So for example, 50 crores is the impairment loss. 50 crores has to be allocated based on the pro rata basis, carrying value. If there is goodwill, entire thing has to be allocated to goodwill. Remaining amount has to be allocated on pro rata basis. And then WDV has to be arrived, and remaining useful life has to be changed. So since that carrying value is changing, remaining useful life has to be changed. So some risk assessment, all these things we will have to do at the initial stage, and estimates. So it's a key estimate. In the interest of time, I'm just moving on. So what could go wrong? So the management forecast can go wrong, assumptions can go wrong. So this we will have to evaluate. And what is a control activity, control summary? So that control activity descriptions has to be in detail. And design factors. So these are the control testing aspects. So you will have to do retrospective review, growth rate analysis, new customer, new deals you will have to investigate. And we have 5 design factors. Each design factors like competence, appropriateness of control, frequency of control, level of aggregation predictability, criteria for investigation and process follow. So aggregation is like what level, what precise management is doing that projection. So projection is a key, and these are all the other substantive testing, like we will be doing what and all we discussed now, that is no shown part of here. Sensitivity analysis and testing disclosure, arithmetical accuracy, and VAU and validation, retrospective testing, budget versus actuals, and comparing changes in key assumptions. So what we will have to do is we will have to identify assumptions. Everything is driven by assumptions only. So significant assumptions we will have to see, do the sensitivity analysis and conclude on it. If we take comfort on significant assumption, what is significant assumption? If we tweak any changes or any input in that assumption, you are getting a very big hit that is greater than your materiality. That is a significant assumption. So that we will have to be very careful, we will have to justify. And reversal of impairment loss. So as per AS 28, so that's a change. Actually goodwill you can reverse. If you allocate impairment loss to goodwill, as per AS 28, you can reverse that impairment loss. As per Ind AS 36, you cannot reverse goodwill. So that's a key change. And AS 28, you will not have investment in subsidiaries, joint venture and associates. It is not covered under the purview of AS 28. In Ind AS 36, that investment is also getting covered. And US GAAP that we already discussed. So it is not permitted to reverse any impairment. So when you reverse, what would have been the carrying value, it should not exceed. So we have some sums. So these are all the presentation and disclosure aspect. It's not working. Yes. So presentation and disclosure. So these are the 5 things we will have to disclose. See, first, it's very important thing is event and circumstances leading to impairment. So this is a key disclosure. Why you are putting an impairment? So that has to be discussed. And if there is a reversal, what is the trigger for reversal? So that has to be disclosed. And pre-tax discount rate has to be given. And what is the terminal growth rate? All these things has to be detailed. If you have goodwill, it's mandatory to do annual impairment testing. And if you have intangible asset with indefinite useful life, it is mandatory impairment analysis. Every year it has to be done. Every reporting period, assessment has to be revisited. So this is that disclosure which has been taken from that listed client. So you can see that CGU, T group is a CGU. So you can refer that first two table, wherein you can see the comparatives for each CGU. They have given what is that carrying amount of goodwill has been allocated, and they have given with the discount rate current year and previous year. For each CGU they have given, and the terminal growth rate they have given current year and previous year. So certain companies, they are simply saying discount rate is ranging from 5 to 10%, 10 to 20%. So these are all insufficient disclosures. We will have to detail the disclosures. So some practical insights which we already covered is there. So allocation of impairment loss. This is there is an impairment loss of 16. So that goodwill is there. Entire thing has been allocated to goodwill, and remaining has been allocated on pro rata basis. So this is what sir was asking, that individual asset-wise impairment. Your machine has suffered physical damage but still working. So it's a kind of, no, it is idle in your case. So whether we will have to do individual-wise impairment or not, this is a solution. So we will have to do that scientific analysis and conclude on it. So you want, you can change the depreciation method. You want to put accelerated depreciation, you can do that, and we will have to disclose. And this is how the allocation of impairment loss to corporate assets. So if you have any corporate assets, if you identify CGUs, still you will be left with some buildings, some land and all. So that is a corporate asset, admin buildings, admin employees. So you cannot allocate these things to the respective portion. So how it has to be allocated? So based on some scientific method, it has to be allocated. For example, each CGU, what is the land square meter area has been covered. So based on that square meter area, it can be allocated. It can be given to CGU. So any allocation method is fine. So here how they have done is based on the carrying value, they have allocated the office building allocation. So 4 and 6. And total adjusted carrying value is this, and recoverable value is this. And finally, CGU A has impairment, CGU B is not have impairment. So I just want to give you an example. Its impairment is not like entire thing. So each CGU wise we will have to analyze. One CGU can have impairment, other CGU cannot have impairment. We cannot club both the CGUs and say there is no impairment. How the impairment loss of 6 million will be allocated to office building? So it is allocated, it is written over down below. Impairment loss will be allocated on the basis of pro rata basis, what we see. So reversal of impairment. So this is a big sum. In the interest of time, I have to skip it. So it is about the Saturn Venus Limited. So same thing, the same maths what we discussed now. What would have been the carrying value? That is the maximum amount of reversal of impairment. So that should be trigger. Just like that, we cannot reverse the impairment loss. So if there is a trigger only, we will have to do the reversal. And this is the NCI portion, apportionment of goodwill impairment. So this is about that theory of pre-tax and post-tax. So end of the day, if you see 1757 and 1757, even if you do pre-tax discount rate and post-tax discount rate with post-tax discounted cash flows, you are getting the same answer. So that's all from my end. Thank you for the opportunity. Any questions? Exactly. So your carrying value, sir. CGU will be your carrying value, closing net block. Exactly. Exactly. Thank you, thank you, thank you so much.
Thank you, Ravi, for the interesting session. With this, we are winding up our workshop for the day. Thanks for your participation. Thank you.